Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, hi. Morning.
Hi, good morning. Thursday morning, the cues are a little better when you look at Wall Street overnight. Gold prices have cooled off from where they were when we wrapped up yesterday's trading session. But it's all going to be about Xi and China, and hopefully we get some diplomatic breakthrough there.
Well, that's right. And we're getting into the second half of May, which is good times because most of the results will start flowing in. And then, gradually...
How many of yours are left?
Quite a few, actually, because mine come with a bit of a lag. But, let's see how...
Action-packed 2 weeks for you next.
Yeah, action-packed 2 weeks. And even today and tomorrow as well, a lot of ferrous names come out with their set of numbers.
JSW
Steel, SAIL. So lots to do. But, Prashant, you've got a little bit of greenish, yellow, I think. Greenish, I think so. So
let's go with...
Let's see.
It's a faded green out, right? Green. So not very much...
Some green will do.
Some green will do, but it's all pastel today. Well, let's just take it from the top then, right? I think oil is at about $105, $106 a barrel. And all eyes on the meeting between President Xi and Trump. And I think we'll have visuals of all of that come through in just a bit from now. So, the expectations are many, but let's see what gets done. The one hope is that China can help with its leverage, being the largest buyer of Iranian crude. It can help Iran sort of agree to some terms. At least that's the expectation from Washington's side, and that's essentially what Trump would hope to do. For China to kind of sort of, help do that. Just in terms of oil, right, the IEA yesterday released its latest report and basically said, it didn't say anything we don't know, but I think coming in from the authority, it sounded, some alarm bells that the inventory draws, global inventory, oil inventory draws are, happening very, very fast. And you may wonder, expectations whether oil will be at this or that, 120, 130. And this is now the 2-month plus kind of number here. And by the end of the month, it'll be 3 months that the strait has been closed. Why isn't oil higher? It's essentially because of inventories that we came into this conflict with global inventory, oil inventories being pretty healthy. But that's being drawn down very quickly. That is what IEA said. They also have points around demand destruction, which is also leading to oil prices staying where they are for now. Now, U.S. equities rallied and to record highs. S&P was up 0.6. The Nasdaq was up about 1.2. But the rally was narrow. So just about 173 names in the S&P 500. So 500 stocks, 173 were higher. And the S&P made a new record high. And only 6 sectors also were up. So narrow. And I think that's it's been highlighted quite a bit. The nature of this move actually all through this year. NVIDIA was up 2%. It's a long list of CEOs who are, by the way, in China with President Trump on Air Force One. It's a big business delegation. So with regards to NVIDIA, they were shut out of China earlier. They were allowed back in. China is a very important, very, very important market. So we'll see. Are there going to be deals which will be done on the AI, hardware, chip side, etc.? Expectations are low. But we'll see if something gets done. But NVIDIA, of course, also reports numbers next week. Cisco was up 15% in the after-hours trade. And I know there are two things. The sales forecast was much stronger than expected, but they also are planning to lay thousands of jobs. This is in line with stock reactions in other companies we've seen in the U.S. Job layoffs and the stock pops, basically, cost savings and better margins and whatnot. So... and of course, they're talking about efforts and focus around AI being the reason why they don't need these many people and the plans to cut these jobs. Kevin Walsh was confirmed as the Fed chair with a 54-45 vote. So it's like a very, very slim vote with regards to the confirmation. He's the next Fed chair. An important one, we've talked about this when the name was first proposed and he was the lead and what policies he could bring about. We'll do that again. But for now, just to sort of tie in the levels here, we sold off, but we did not, break lower, and we got a bit of a bounce yesterday. So 23,262, the recent low is the support, and the recent high, which was the earlier support, 23,800, is the resistance level. So it's moved lower. Broadly, it's a 1,000-point range, low to high. But we're at the lower end, absolute lower end of this range, 1,000-point range. So 23,260 on the downside and about 23,800, at least in the very near term. GIFT Nifty gives you a quick sense of how we likely to start, and then we will pick it up from there. 80-odd points higher. Nigel has walked across with the F&O positioning and the Qs. Nigel, take it away.
Well, Prashant, one wonders if President Trump is being pushed into a bit of a corner to call off this war, or at least, withdraw his stance a little bit. I say this because inflation is moving up in the United States, and the US bond yields as well. They have moved to the highest levels we've seen in multiple months, all the way since July, I think. So it's close to around 4.5% or thereabouts. So with the bond yields moving up, in the past we have seen that that's what forces President Trump, to take some kind of action. So the bulls will be hoping more of the same, and maybe he cools off his stance with regard to the war. We'll have to see how that goes. The dollar index as well has shown some strength, while Brent crude prices remain at elevated levels. So the troika is not really in favor of equity markets. You'll want to see some cooling off on all these three parameters. Coming back home, the Indian rupee. That's a one-way slide that needs to stop, that needs to turn sentiment, because you've seen a couple of measures that have been announced. But the Indian rupee yesterday as well at around 95.7. You can't have the rupee at these sort of levels. So you'll want to see some kind of stability and a bit of a pullback from these levels. The India VIX as well is threatening to move towards the 20% odd mark. Remember, that's the volatility index. That's the fear gauge as well. So we'll have to keep an eye out on this one. In terms of flows, the rupee is weakening. So you can't expect the FIs to be big buyers or, even cool down their buying. You want to thank God for small mercies, because yesterday's trading session, at least, the FI net sell number came down to sub 5,000 crores. And the institutional number, that's the DI and the FI number, you put it together, it was net positive in trade yesterday. Not too much movement on index futures, but the takeaway is that the FIs remain aggressively net short with close to around 89% of their positions on the short side. And if you look at it in absolute terms, the FI net shorts, ballpark around 2.4 lakh contracts on the short side, while the clients, they as well have been adding longs. So they are at around 1.7 lakh contracts on the long side. Diametrically opposite, not so bad, but we need a trigger to trigger that short covering bounce. We'll keep an eye out on that fact. Well, stock futures, yesterday the FIs at least added more longs than shorts. So that was encouraging to see. Individual stocks will continue to do a thing of their own. And as I mentioned as well earlier, that the 23,500, there appears to be a bit of a strategy on the call as well as put. A short straddle out there, pocketing close to around 450 to around 500 rupees or thereabouts. And you're working with this broad range between 23,000 and 24,000 odd. However, over the last few trading sessions, the Nifty has been making lower lows and lower highs. So you'll want that trend actually to reverse. If we just pull up the last few trading sessions, you'll just see that the Nifty's highs have been getting lower on a day-to-day basis and the lows as well. So if you're looking at levels to look at for today, you'll want the Nifty to actually get past this mark, which could happen actually going by what the GIFT is suggesting, and hold above this level. So hopefully we'll make a higher high as well as a higher low for today, which will break the trend that we've been seeing in the last few trading sessions. And finally, advanced decline ratio. Yesterday we had more number of stocks advancing than declining, but it was not very, very convincing because those lines came together. You'll want some kind of consolidation on the headline index, but the breadth of the market to continue its outperformance that we have got used to over the last 45 days. So that's all the cues.
Thank you very much for that. A quick check on Asia before we proceed. Skewed to the buy side. So there is green on the screen when it comes to the Taiwanese markets, the Korean markets. They're up close to about 0.5%. The Japanese markets too have opened up in the green with a gain of about 0.3%. Taiwan now inching towards a 1% up move. And the GIFT Nifty too is suggesting a positive start. Yesterday we managed to close above 23,400 in a volatile trading session. We could add a little bit more, 85 points up on GIFT Nifty. Arvind Sanger now, a managing partner at Geosphere Capital Management, is now joining in. Arvind, thank you very much for joining in. Should we keep our hopes alive on any breakthrough coming out from the Trump-Xi Jinping meeting today? Because we've had weeks of unsuccessful negotiations or resolution on the Iran front.
I doubt it. I don't think China has a magic wand to fix the Iran problem. I think Iran has its own interests, and its interests are to make sure it doesn't get attacked again. And I don't think China can guarantee anything about whether or not that'll happen. So Iran needs to keep control on the Strait of Hormuz to make sure that it has some leverage against any future actions by Israel or the US. So I don't think there's I think the hope that the market has is, in my opinion, largely misplaced.
Should we keep any hopes alive on the tariff situation between US and China? Because that has implications. If there are easing of chip exports from the US into into China, etc., that could continue to keep the Nvidias and the tech rally alive. And we've got all the tech CEOs on board this trip.
Yeah, I don't know how far they will go on that front, but clearly they're hoping to do some deals. I don't know which deals will happen, which will not. But the AI US tech AI rally is not really dependent on the China deal. Maybe Nvidia would be as a single point a beneficiary if there's a deal to allow some of the more advanced chips to be sold into China. But in terms of what's driving the US market, in terms of the tech rally, that is not that reliant on this China trip. That will continue on its own. But the big fly in the ointment is if there is no resolution on the Strait of Hormuz and oil prices keep climbing, then the market, the tech rally and the AI rally could take a bit of a breather if interest rates keep rising and inflation fears keep rising.
Arvind, good morning. If there's, I don't know if it's any indication, but President Xi was not at the airport to receive Trump. So I think he sent his senior most leader, and I think the U.S. ambassador to China was there. And there was, of course, all the celebration and a warm welcome, etc. But the man himself was not there.
I'm not sure what to read on these tea leaves, but I think the reality is that Trump is going with a very weak hand. President Trump, is facing problems, inflation, and obviously the Iran war. President Xi has his own troubles in terms of his own economy, but not in as bad a shape as the U.S. is right now in terms of the immediate impact of the Iran war. So I think President Trump needs something from China more than China needs something from the U.S. at this point. And so it'll be interesting to see how the dynamic of this conversation plays out. I'm not counting on any great shakes. Maybe they'll agree to buy some stuff. Maybe U.S. will agree to sell some tech-related hardware. But I'm not sure that changes the narrative of either economy in a meaningful way. I think the Iran war is the dominant concern right now, and I'm not sure there's any magic bullet that can solve that comes out of this China-U.S. dialogue.
Just one thing, Arvind, the midterms in the U.S., do you think President Trump has kind of given up on it? Saying, well, I'm not going to win it anyway. Because that was being talked about as a pressure point, the deadline, and maybe he's got to get this resolved much earlier. Or do you think, because U.S. stock markets have been incredibly resilient, and in the last term, he was very bothered about the level of the Dow or whatever. Level of the stock markets in that sense. And this time, through all of this, markets have been resilient. So I don't know if that is being read as a signal of the economy and markets being unbothered.
I think that divided government has usually been good for markets. So the markets don't care whether or not the Democrats win Congress or not. For President Trump, I think I'm not sure, there's a lot of stuff going on with redrawing boundaries of, what we call gerrymandering in different states. So I think the Republicans are trying, but it looks like the House is going to be hard to hold. I think if I'm President Trump, I'm hoping that, that I can do enough to keep the Senate in Republican hands. But in terms of the markets don't care. The markets do fine whether or not there's a divided government or it's a unified government. So I think from a market standpoint, the economy is more important than whether or not Republicans hold on to Congress or not.
Arvind, what about the Indian markets? You were on the sidelines, I think, for a bit, going by the cues that we had. Indian markets, actually, we have relatively underperformed now for close to around 18 months or thereabouts. Even off late, we've pulled back a little bit more. What's your view on the Indian markets right now, and any sector theme that you're latching onto?
Well, I think that oil is going to $125 a barrel. So I don't see a reason for Indian markets to be outperforming. I think, in fact, one of the criticism, if I could make one, is that Indian investors and Indian policymakers have been counting on and not taking the tough actions needed to correct demand to deal with the fact that this crisis might last longer. And I think we're finally seeing signs that the government is waking up to the fact that this is not just a passing issue, this could last a lot longer. So I think from a market standpoint, the economy is more important than whether or not President Trump wins Congress or not. So I think once we see a little more belt tightening in terms of prices increase at the pump, dealing with the impact of probably tighter fertilizer, and we could have with a strong El Nino some weather issues that could affect monsoon. So I think there's enough clouds on the horizon on a macro basis that I'd like to wait for markets to get a little bit more sign of reality in terms of the fact that this quarter earnings growth was fine, but this is a little bit backward looking, and there's enough clouds on the horizon in terms of potential inflation, potential food and fuel inflation that I don't think is completely discounted. So we're staying somewhat cautious. We're looking at opportunities to buy stuff when they pull back a lot, but we haven't seen that dramatic a pullback to make it a table pounding buy yet.
Got that. And just a quick view on this. You've got a ringside view of what's happening with AI and the AI trade in the US, Arvind. How would you read the temperature on that? Absolutely.
I think it's hard to see it stopping. I mean, I think the CapEx story keeps getting better, as you've seen from news from Anthropic, which is talking about raising money at a 900 billion valuation, and the revenue growth that they're seeing, that's getting better. So I think the signs of AI adoption and AI impact are continuing. Look, nothing is ever a straight line. There will be bumps along the road. There are companies like Meta, which are spending a lot of money, which have nothing to show for it. So I think that there is going to be, there are going to be bumps along the road as people realize not everybody is going to be a winner. There are going to be losers. And so far earlier there was a concern about the software companies, but I think some of the big hyperscalers that are spending money, not everybody is going to earn a return on investment. So right now, it's a generally feel-good moment. I think there will be bumps along the road, but in general, the AI adoption continues to be doing very well. So I think the AI trade will continue, but there'll be some hiccups along the way.
Yeah, never a straight line. Thanks very much, Arvind. Appreciate you joining us. Good speaking with you, and it's a pleasure here on CNBC-TV18.
Thank you.
All right, well, let's just quickly run you through what's coming up here in terms of interactions on the program. 8:35, the Borosil Renewable Management will be with us. Mr. Keruka on the fourth quarter numbers and outlook. Prabal Sen will join us on oil, HPCL, the outlook. Lots to talk about there. 9 o'clock, that conversation happens. 9:20, Manishi Raychaudhuri. We'll talk markets. 9:30, the management of Keynes Tech will speak to us on their numbers. Vinity Organics will follow at 9:40. IKS Health after that at 9:50 towards the end of the program. Reddington joins us on the quarter gone by. So it's, earnings and earnings and more earnings as we race into the end of this earnings season. So lots of stuff. Nigel.
Time to slip into a short break. We go full tilt on stocks on the other side in our special top 10 segment. For the time being, I'll run you through the list. Bharti Airtel, Oil India, Bharti Hexacom, NLC India, Crompton, all of them will be reacting to positive news flow. You have IKS as well as Zydus that will also be part of the stocks reacting to positive news flow. Tata Motors CV will be reacting negatively. Keynes Technologies could get clunked back. And sugar stocks as well could pull back. We'll tell you more about all of these names on the other side of the snappy break.
Welcome back. Let's talk about stocks. This is CNBC TV18's list of top stocks for the day. Our entire research team joins in, preps you up with the stocks. Hi, guys. Good morning. Hi, girls, I should say. But let me begin this one with Bharti Airtel. Now, there are two sets of news. One is the numbers and the second one is the deal. Now, purely on numbers are slightly muted, particularly on the India mobile business, which is 50% of their revenue. So consolidated numbers are in line because the homes business is doing well, Africa is doing well. But the India mobile business, the B2C business, has been subdued with a growth at just 0.6% quarter on quarter, lower than street expectations. Year-on-year revenue growth has come down to 8.3%, and this is the lowest I've seen in the last many quarters. The average revenue per user has also dropped by 2 rupees, and numbers are weaker than what Jio reported in Q4. But then is the second part, that is the deal. Now, on expected lines, Bharti Airtel has said that they will be acquiring 16% stake in Airtel Africa from Bharti Enterprises. The term is ICIL, but that is the Sunil Bharti Mittal owned family, which owns has taken Bharti Airtel and Bharti Airtel. So the listed entity will buy 16% stake from the promoter family in Bharti in Airtel Africa. With this, their stake will rise to close to 79%. But the street was fearing that it could be a mix of a share as well as, share swap. But Nimesh told us in closing bell yesterday that it will be a share swap. The total deal value is 28,220. For Bharti Airtel, shares will be issued at a premium of 9.5% at 1,923. And more importantly, the company has said it's cashless, leverage neutral, and it will be EPS accretive for the Airtel India entity. And I think that should allay some concerns because the stock in the run-up to this particular set of numbers, ever since that deal expectation came to the market, the stock has been a bit subdued. So numbers miss, but the deal has been announced and it's going to be a complete share swap. So let's see how the stock reacts. Yesterday, in anticipation, I think it went up nearly 2%.
Got that, Rima. Thanks for that. Well, let's hop across to Sudarshan. He's focusing on Tata Motors. Morning, Sudarshan. You're expecting a negative reaction?
Good morning, Nigel. So Tata Motors commercial vehicle had reported earnings for Q4. Earnings looked very good, but the problem is the outlook that company has given both for Q1 FY27 and also for the entire fiscal. So first, talk about the earnings. Revenue has seen a growth of almost 19%, aided by the strong volume growth both on a sequential basis as well as year-on-year. So on a sequential basis, volumes were up 15%. YY, it was up more than 25%. And EBITDA has seen an increase of 37%. Margin too has jumped and it has come at 12.8%. From the level of 11% in the same quarter last year. Now talking about the outlook, company is saying it's expecting high single-digit growth in Q1 FY27 versus more than 25% growth that company had seen in Q4. Now, what's the problem is going to be? The sharp increase in commodity prices. So it believes that commodity headwinds is going to be significantly higher in Q1 and company is not going to pass on the entire raw material increase. Now margin guidance for the entire year is teens versus the earlier guidance of mid-teens. Talking about the international business, reduced fuel availability is creating some issues in Sri Lanka, and so international business also is going to remain under pressure. Talking about the brokerage views, Nomura has downgraded the stock to neutral and target price is 402. So I'm going with red, especially because of the cautious outlook.
All right. So thanks very much for that. Well, Oil India in focus. Sonal is here with details. Sonal, good morning.
Good morning, Prashant. Well, good set of numbers expected because of higher realizations that we saw in the quarter gone by. Revenues for the company are up 21% on a sequential basis, EBITDA up 39%, margins have improved 400 basis points, leading to a profit growth coming in at almost doubling at 1789 crore rupees versus 800 crore rupees. Interestingly, there is an increase in production as well of oil on a YY basis, up 6%, and the realizations are up 5% to $74.46 per barrel. So going with green, additionally, the royalty cut tailwinds are something which are positive for the stock as well.
Okay. All right. Thanks a lot for that, Sonal. But coming back to you, Rima, Bharti Hexacom, how are those numbers?
Well, it's a steady set of numbers. So revenues are up 2.3% quarter on quarter. Year on year, it's up 5.5%. The company has maintained margins at 54.4%. Profits, though, are slightly lower on account of higher other expenses and slightly higher exceptional costs. But again, along with Bharti Hexacom too has been an underperformer. But numbers per se are on the steadier side. But let's move on now to NLC India. Vivek joins in to tell us the news.
Well, good morning. Very strong set of numbers as far as Q4 is concerned. Remember, some key projects, especially Katampur, all of these projects have actually been commissioned in FY26, and that's contributed quite significantly to the earnings. So revenues high by almost 31.5%. Strong operating leverage has ensured that EBITDA has jumped up almost a little over 2 times. Margins very strong, over 1,000 basis points expansion. Profitability higher by 2.9 times. So very good numbers. Segmental revenues, when you're looking at it, mining revenues up almost 21%. Thermal power revenues up 35.5%, and one of the few companies that have actually seen strong growth as far as the renewable power generation is concerned, up 20%. The company, however, has gone ahead and cited that they continue to face land availability issues that naively impacting the mining operations there. But overall, a good set of numbers, and important to see when the company does go in for the renewable energy arm IPO as well.
Got it. Okay, thanks for that, Vivek. Well, Upasana, one of the stocks of the day is going to be Kaynes Technology. That's going to be an interesting conversation. You're tracking both of them, Kaynes as well as Crompton. Go ahead.
Good morning, Nigel. Well, first up, let me start with Keynes. Well, it's a miss across the board as compared to our poll. Now, company has missed its own guidance and even what the street was anticipating. Now, the street was anticipating a strong revenue growth this time around, and it stood just about for Q4 around 1,200 crore versus the guidance of 1,700 crore given by the company in Q4. So overall, if this pans out, a revenue growth of just 26% that the company is given versus our poll of 53%. Coming to the margins also, EBITDA margins down 160 basis points at 15.5% versus our poll of 16.1. PAT is also down, under pressure, down 21% on year-on-year basis. Now, on full-year basis, if we look at the company, FY26 revenue growth stood at just 33%, and the company has missed its own guidance of 51% growth. In terms of EBITDA margins also for FY26, it stood at 15.8% versus the guidance of the company given 17%. So it's a miss on that front as well. Now, when it comes to companies' cash flows and even the working capital cycle, even this is much stretched. So we'll be looking out at what exactly has panned out here. And company's overall OCF has further stretched to negative 600 crore, and company has also missed its guidance here of turning cash flow positive by end of this year. So certainly a stock that we'll be keeping an eye out on, and a lot of questions to ask to the management as well. Now moving on to Crompton, overall an inline set of numbers. Revenue growth strong at 11% on a YoY basis. It is driven across segment, be it ECD, SDA, LDA, all have been firing out guns. Now, EBITDA margin stood at 11.9%, down 110 basis points versus the poll of 11.5. Adjusted PAT up 9%. And now coming to the segmental performance, ECD performance stands in line with the estimates that the street was working with. It has shown a growth of 9% on year-on-year basis, led by price hikes in fans, solar pumps, and even SDAs. Now, revenue in ECD is up about 9%. Margins are down 120 bips at 15.5%. And coming to lighting business, it has reported one of the strongest growth quarters within revenue uptick of 14% is what the management has also indicated. And Butterfly, overall stable performance. So going with green in Crompton, and Keynes certainly a red here.
Thank you very much for that. Vinny is here to tell us how IKS Solutions numbers looked.
Hi, good morning. So in terms of IKS, good numbers that have come in from the company. Growth momentum that has sustained, right? 19% growth in Q4 FY26. For the full year also, they are managing the 20% growth rate as well. Margins, 340 basis point expansion for Q4. Mainly, obviously, the equity acquisition which they made, that's working out for them. Operating leverage is playing out now for the company as well. And overall, they'd spoken about mid-30s range, what they are comfortable in terms of margin. That is what is sustained. Now, is this the peak is something that we have to understand, but 35% margins is the best that we've seen in the last couple of years for the company as well. Profits of the company also are managing to see a good growth. Apart from that, they've given a vision 2030 they've spoken about, right? Where they want to get the EBITDA to 3,000 crores by 2030, currently at 1,000 crores. So almost a 3x jump is what we're seeing. They made a small acquisition that is there of AI Solutions, which is mainly on AI R&D. It's a very small acquisition, but still pushes them more towards the AI focus that they want to continue on. Good numbers from the company. We could see green on the screen.
All right, and we have the management board joining us a little later. Thanks very much, Vinny, for that. Sugar producers and sugar companies in focus. Manisha is here with details. Manisha, good morning.
Morning, and thank you for that. Well, yes, India, in a notification late last night, has banned sugar exports until September 2026. The exports of raws, whites, and refined sugar, all of that has been banned with immediate effect. The only plus point is that the government says in the notification that they will allow shipments already in export pipeline, which are under specified conditions. Now, India has done that, and this was perhaps anticipated as well, because the crop estimates earlier were at around 32 million tons, which were continuously revised onto the lower side, which now perhaps stand at 27.5 million tons. This has been due to erratic weather, lower yields, etc. Also, concerns that El Nino could disrupt this year's monsoon has been playing onto the regulators' mind. If you look at the closing stock, that also has been much lower. Markets are anticipating that at around 3 million tons. And overall, when you look at the export that was allowed, was at around 15 lakh tons. Out of that, 7 lakh tons has been contracted or exported as well. So this decision basically comes in on 6 to 7 lakh tons of exports. Markets were looking at a positive side of it because the rupee has been depreciating and there were markets which wanted sugar. But this sudden stop at this would perhaps be slightly on the negative side for the sugar industry.
Okay, all right. Thanks a lot for that, Manisha. Well, going across to Ekta, she's here to tell us about Zydus Life. Morning, Ekta.
Well, it's definitely acquisition season for a lot of the pharmaceutical companies. So Zydus is going to be acquiring Certeo Holdings for $166.4 million in an all-cash deal. It is a U.S. specialty oncology company. It will be via a tender offer followed by a merger of Zara, which is Zydus' arm, into Certeo, and it will eventually be delisted from the NASDAQ. The portfolio includes a cancer drug called Rolvedon, which is basically received a biological license application by the US FDA. So the street seems to be optimistic on that. CY25 sales for this particular company stood at $68.23 million versus $60 million on a year-on-year basis. Zydus is also going to consider a buyback on the 19th of May when they meet to declare their numbers.
Thank you very much for that. Let's do a quick recap of the top stocks with positive news flow are Bharti Airtel, Bharti Hexacom, NLC India, Crompton, IKS, Zydus Life. Stocks with negative news flow are Tata Motors, CV, Keynes and Sugar stocks. But that's equities. Let's talk commodities. Manisha is joining in as always. Manisha.
Thank you so much for that. My focus totally today is on the metal as a space, because while we're looking at gold prices trading stable, silver has been holding around that $87, $88 an ounce mark. But it really has been about the base metal prices, which have seen a surge. The tight near-term supply, strong China economic data, decline in inventories on LME and Shanghai as well. And then there have been various reports about ongoing mine closures, operational disruptions, and that sulfuric acid shortage. All of that has been keeping the prices on the higher side. If you look at the U.S. copper, we are not trading too far away from its all-time highs. Aluminum is trading at a 4-year highs. Zinc prices at a 3.5-year highs as well. Platinum at a 2-month highs, palladium prices at 1-month highs as well. So everything that you see in case of metals is trading in the positive in Asian markets right now.
Thank you very much for that. Get into a break. On the other side, the management of Borosil Renewables will join in to talk about Q4 numbers and the way forward.
Welcome back. Hope you're having a good morning. Well, for starters, I think the GIFT 50 is suggesting that we start off in the green, but individual stocks are going to do a thing of their own. Let's welcome Deepan Mehta, Director at Elixir Equities, who joins us on the show. Hi, Deepan. Good morning. Good to see you in. Deepan, you know, there'll be a lot of frontline names that we'll be discussing, but I want to ask you about Keynes Technology, and I'm looking forward to the chat that we'll have with the management. You know, the management assured investors they're going to be achieving the guidance that they set out. No heads up was given. And that's why the numbers come as a bit of a shocker. If the stock is under pressure today, what is your view? Because they've been saying in the past, revenues will move to $1 billion odd. But this sort of numbers actually will warrant a bit of a reaction on the downside.
Yeah, good morning, Nigel, and thank you for having me on your show. So I think investors need to understand that there's going to be some volatility in the earnings depending upon the order flow and the deliveries. But you can take heart from two facts. One is that they have a solid order book position. I think at last I checked almost 2 years, current years, or rather FY26 earnings. And I think the big action in case is to be the OSAT facility and how that's going to play out. I think it's a high risk, high return type of a project, and it will overshadow the existing business also. And that's the key, I think, variable to watch in Keynes Tech. But nonetheless, I think results are decent. The problem is that expectations run a bit higher than what the company can actually deliver. And such corrections, if at all they take place, are good opportunities to enter if you have a 3 to 5 type of a view. Because just as one disappointing result has come this time, one can always expect maybe somewhere down the road, you could have a result which is far better than what the street is expecting. And that would correct this kind of a bad number, which the street perceives it to be a bit negative.
Is that a, Deepan, morning, is that a general comment or a Keynes specific comment?
So I think, Prashant, you know, sometimes for these high flyer stocks, the analyst expectations are really high.
Yeah.
And companies also do not manage the expectations better. And look, you know, these earnings look fine on Excel, but at the ground level, there are many challenges. And sometimes, you know, just one smaller thing like postponement of a delivery or a sharp increase in the raw material cost or some unusual item can cause a kind of a decline or at least lower than expected profits. But underlying business is very good. and top line I think has grown pretty well. And I think it's quite commendable that Keynes at least going into semiconductor manufacturing, which is the need of the hour.
Dipan, what's your read on Bharti Airtel? You know, the numbers are disappointing. Even the dividend that they've paid out, 24 rupees, is slightly lower than analyst expectations. But then there is that Airtel Africa stake increase by nearly 16%, and it's going to be cashless. What's your view?
I think again, same thing that we were fine with the results. 15-16% growth is what you should expect on a mature business like this. And it came with those kind of numbers. Of course, there's an extraordinary expense. But by and large, I think a lot of uncertainties around Bharti Airtel are over and done with, especially in terms of AGR dues and stuff like that. And I think that the Airtel acquisition of Africa is very positive. That geography is growing faster than the Indian geography. It makes the entire shareholding pattern and the structure far more simple. And at the end of the day, I think it's amongst the few large cap nifty companies which can still grow at beyond 15%, because there are very few of such companies. Only disappointment, if you ask me, is the ARPU increase is not as per what we expected. But, I think we remain in hope, and at some point of time, they will be able to nudge that figure higher. But on the whole, I think great set of numbers, interest cost, depreciation costs, all kind of flattening out. So it does show that eventually return ratios also will improve for Bharti Airtel.
Well, it's earnings season, so we get to our first management. Stay with us, and Deepan, lots more questions coming your way. Borosil Renewables is the company. So I think, decent fourth quarter, but for the full year, I think there is still a loss. What will FY27 hold? That's the question. Pradeep Kumar Kheruka is Executive Chairman of the company. Mr. Kheruka, good morning. Good to have you with us here. Prashant this side. So, the Jan to March, of course, we'll talk about some specific numbers and what we can glean from that. But just put out the 27 expectation, if you can, sir, on the top line. What are you expecting? And at a EBITDA level, what are you expecting? What kind of numbers?
See, the operational results for the year have shown a reasonable margin. It's about nearly over 491 crores EBITDA. And the loss figure that you talked about is after setting off the loss that we had provided for last year from the German subsidiary. But operationally, we have done well. And the next year, we expect there to be a marginal improvement. Now, the way the expansion is coming up, we do expect we are on line to grow by about 60% this year. Meaning we expect installed capacity to be in production or started up within this year. So I can speak for 2028 that the figure should be about 60% higher in terms of turnover, profitability, everything. This, of course, subject to what we know, the uncertainties of everything. But everything seems to be going quite well in terms of demand, in terms of production, and there seems to be nothing on the horizon that should be interrupting us.
So FY27, you say about 500 crores in EBITDA, and for the full year, 26, you're saying marginal growth, single-digit growth in EBITDA in 27, and 28 then will be a big year because of the additional capacity which comes up.
Right.
Got that. Some of the issues you've spoken about, which is freight cost and now, of course, there is the power cost as well, right? With what's happening. Could you give us a sense of how that played out and what's playing out now?
The power cost for us is not very bad because we are now significantly on renewable power. And with the renewable power that we now have, the prices are not subject to the power prices nationally otherwise. And the possibilities of natural gas going up do exist. But so far, we've had no curtailment in supply. We've had a marginal bump up in the cost of natural gas, but we were able to pass on some of that to our customers. So we have not really suffered very much from power. And going forward, I'm not sure. This is all very uncertain. On the one side, we see a lot of activity which is geared towards solving the conflict. On the other side, of course, it's dragging on much longer than most of us would have expected. So Other than that, I do not see any other major impediment on the horizon. Of course, some raw materials might go up, but that's a little uncertain. That could be because of freight rate and so on. I don't see any major roadblocks coming up at this time.
Good morning, Mr. Keruka. This is Rima here. So till your expansion comes on board, that's in December of 2026, what would be the volume growth of the company for this 9 months of FY27? Last year, you were at 8%. Will it be similar? Do you do better? Can you push to double digits? And you said that the overall cost is manageable. So can you hold on to EBITDA margins of 30% that you clocked in the quarter gone by?
You see, we can only speak based on the visibility today. Based on today's visibility, it seems that there should not be much change. And growth also about 8% is something that we could try to achieve within the year with further, improvements in operational efficiencies and so on. And with the possibility of getting some extra production from at least one of the furnaces that we are planning to be coming online. So we expect that one furnace we might be able to light up in January, and the second furnace perhaps in March. So next year, of course, we can see 60% more glass coming out.
So this year, it should be similar to last year, about an 8% volume growth. In FY28, when your capacity goes up by 60%, your overall turnover goes up by 60%. You've also sought a shareholder note to raise 750 crore rupees. Are you looking to raise that money? If yes, by when? And what will it be used for?
At the moment, this is an enabling resolution. We are in a dynamic world. You see, the solar business is taking off with even more energy than it was last year. And that's because of the uncertainty of oil supply and so on. People are shifting their focus to solar. And it's a matter of time the nation is going to move away from LPG for cooking to induction heaters, which are more efficient. They're cheaper than LPG in terms of cost, and they are faster than LPG. So induction cookers are really the best way to go, and these use electricity. And if you think of a billion people cooking on induction instead of LPG, that would add up to a sizable demand. We're looking at data centers. So at the moment, there seems to be no end to the demand for electric power. Everything associated with power, I think, is going to be on a rise.
Yeah.
And fortunately, we have negotiated the headwinds politically. We have sort of emerged unscathed, other than the cost of oil, to which I think that there's no solution.
Everything okay and set in terms of the duties, right? I mean, that's been it's a big mover for you.
That's been a very big mover, and a very timely mover, I might say, because the government has seems to have taken a decision, with a consolidated, concerted decision to improve and to install a full-on manufacturing base in India for the entire solar value chain. And next year, we are seeing some further changes in terms of cells. We are seeing changes in cells coming from the next couple of months, when imported cells will no longer sort of be allowed to be used. And after that, we're looking at polysilicon ingots and things like that. So we are going to become a very strong renewable energy manufacturing power in India.
But there are enough Indian players who are kind of backward integrating, and that's the competition perhaps which we've spoken about in the past as well, Mr. Keruka. We'll leave it there for now. Thank you very much for joining us. Good speaking with you, and good luck with 27, as you say. We'll see some growth, but 28 with more capacities will be the big one. We'll take a break. We're back. Deepan is, of course, with us, and we'll ask him about stocks, more stocks which are in focus yesterday and on results after market hours. Mitesh and Sudarshan also join in with some technical trading ideas. Stay tuned. Welcome back. We've got Hormuz now joining in with the delivery numbers and the stocks which made the moves yesterday. Hormuz, morning.
Morning, Prashant. And MTR Tech was one such name that we have not stopped talking about all through the year now. And it has extended its year-to-date gains after yesterday. The company extended raised its guidance for FY27. The stock was up almost 10% yesterday. The volumes were the highest since January of this year. 45 lakh shares were traded. It's 5x its 20-day average. And even on the delivery front, 13% of those shares were marked for delivery. So around 6 lakh shares for delivery. That too was 3x its 20-day average. It was the second most traded stock on the nifty in the entire broader market scenario on Wednesday, and it ended at a record high as well. And in just the first 4.5 months of the year, the stock is already up 185%. Now, what was the most traded stock on the Nifty 500 yesterday was SAIL, and that stock was up almost 15% yesterday, the biggest single-day gain since March of 2020, and it snapped a 3-day losing streak. The premiums on the 190 call option, of course, we don't talk about sales options quite frequently, but was up over 900% on Wednesday. The volumes were the highest since April of 24. Almost 17.5 crore shares were traded. The 20-day average is only 2.5 crore shares, and a third of those were marked for delivery. So 5.5 crore shares for delivery. The 20-day average is just 1 crore. And the stock, though, ended at a 52-week high, but you must remember that the stock is in the F&O ban, so you can't take new positions here. And lastly, possibly the earnings reaction of yesterday was Dixon Technologies. That too ended 10% higher in yesterday's session, the biggest gain in 2 months. It snapped a 4-day losing streak as well. The 11,000 call option was the most traded on Wednesday. Premiums going up by 150%. Volumes here were the highest since October of 24. Close to 30 lakh shares were traded. The 20-day average is around 6.5 lakh shares, and a quarter of those were marked for delivery. So 6.5 lakh shares for delivery. The 20-day average is just around 2 lakh shares. It was the second most traded stock on the Nifty 500 on Wednesday, and the stock, even though it's down around 8% for the year, is still down over 40% from its 52-week highs.
Thank you very much for that. Dipan, MTR Tech, as Hormuz said, we can't stop talking about it now. 180% higher from the start of the year. Q4 numbers were good. Guidance raised from 50% to 80% growth for next year. But still, 180% up this year, 300% plus in the last 1 year. So what to justify?
You're putting salt on my wound. I've been having two companies, MTR Technologies and Paras Defense, on my screen. I have a charting screen in front of me, and every time I'm thinking of buying, I don't end up buying because of valuation, and the stock price keeps going higher and higher. The numbers keep on coming. It's, I think, something which has been missed completely. Fabulous play. At least MTR is a fabulous play on the data center investment theme, and their connection with Bloom Energy is quite amazing. And if you read about what Bloom is doing and what MTAR means to Bloom, then it's a very, very solid investment case. But it's just valuation 100 times. I mean, I don't know, in the past, whenever you bought a stock 100 times, it's never worked out for you. And that kind of a thought, holds me back. But nonetheless, I think existing investors can laugh all the way to the bank. They can congratulate themselves. And we remain in hope, I think, at some point of time when the stock is at reasonable valuations, maybe because of a correction, maybe because of significantly higher numbers, it may provide an entry point, but otherwise one of the solid value creators of at least 2026 so far.
Deepan, I'm looking at this note from Philip. I think it's Philip Capital on MTAR. They say that in FY20, so FY27, FY26 earnings per share is 35 rupees, 27 is 80 rupees, and 28, 80 will become 155. So they're saying they're giving a 50 times multiple on FY28, and they get some, I think, 7,500, 7,700 kind of price target on MTAR. So
that's the thing, Prashant. We talk about analysts having very high expectations. This is the thing, I mean, how do you justify 7,500 rupees price unless you don't work it backward to a 50 rupee earnings per share? So,
yeah,
it's all about building the expectation. But I think, if you watch the company closely enough, you do get opportunities. I've seen that time and again. If not this time, then this correction, some other correction. One bad quarter also, because these are all capital goods manufacturing companies. One bad quarter may see 30-40% correction in stock price. Those are good entry levels. So I think you just have to wait for the catch to come to you, so to speak in cricketing terms.
Yeah, I'll tell you, you said it's a salt on wounds. We spoke on Bazaar, Rima, I don't know if you remember, this conversation we had at $1,400. And by the way, this was not some eons ago. This was last year. This was in 2025, I think September 2025. And I mean, it just struck out to me at that point. I remember very clearly because they said, well, you know, we are expecting 40, 50% kind of growth. I think some crazy numbers next year. You know, and this is just a few months ago. So it's been an incredible kind of move. It's been just discovered, I guess, right? With I guess it was people who knew, but I think a whole set of newer investors have come in. I guess there's institutional participation, etc. as well. And all the hot button right spaces, there's space, there is defense, there is nuclear as well. And of course, I mean, the AI data center, the Bloom partnership that you spoke about. So one of those areas which has done phenomenally well in that sense. Deepan, do you have, you said you have a software. Do you have Sterlite Tech on that software in terms of the...
No. Yeah, it's looking interesting. Definitely looking interesting. But, you know, just the track record of the company and a bit of a commoditized type of a product just kind of holds me back. But yes, I think seriously looking at it quite closely, again, a great data center play as well, good export opportunities. And Prashant, you know, now what I'm thinking more and more is that I want to look for businesses which have got export competitiveness. And, you know, rupee at 95 is a certainty. It's going to be there for a long, long time. And that will change the dynamics of many exporting companies. Okay, they may have to cut the price because of rupee depreciation, but they'll become more competitive. And companies which are having 40, 50% revenue from exports, I think those are really worth studying quite closely. And even if you see in this particular earnings season, companies which have got an export business, they tend to have done better. That is one investment theme. And secondly, those who derive a lot of revenues from overseas subsidiaries, because when you convert those overseas subsidiaries into INR to consolidate, then that automatically adds to the bottom line. So that's something which we are working on quite closely in this earnings season.
Yeah. You know, the story with Sterlite seems to be they are just pivoting away from telecom to data centers. That is the story. And they are, from what I understand, they're not so much focused on India because the demand will pick up, but demand is not there. It's exports with regards to servicing clients overseas in the US. That's a story. And the optic fiber, I mean, it's more complicated. I mean, you can produce it on the same line with upgrades, but you got many more, I mean, thousands more threads in that one single optic fiber. So that's the difference between supplying to telecom and supplying to data centers in that sense. But you know, that's why I think a very large foreign investors picked up shares, 100 to 400 this year. Just one more set of names very quickly, Deepan. One is Fractal. There was the lock-in ended yesterday. Stock was down 10%. It's a good company, AI, and they seem to be doing all the right stuff. And the other one is CleanMax, all recently listed names.
Yeah, Prashant, first the disclosure, we have just invested in Fractal Analytics after the result, and you're looking at mark-to-market losses immediately, but very positive on the company. There are going to be only 5 or 6 winners within the software space, and I consider Fractal one of them because of the AI disruption, so very positive. And CleanMax also, I think, very good set of numbers, very aggressive growth in the kind of capacity addition. They have been hit by higher interest and depreciation costs, but that will kind of normalize over time. So both these companies are definitely worth keeping on your radar and tracking them quite closely.
Yeah. Deepan, if you, fair enough, both interesting names and recently listed. If you'll allow it, we'll just like to sort of, go to China for a bit. The Xi-Trump summit is underway, and it's a big one. So what will come out of it, we'll have to see. But this is the report, I think, which CNBC's Elaine Yu sent us a little while back, just summarizing what's been happening on the ground there. So watch this.
So far, they have been hailing the importance of U.S.-China relations. So when their bilateral meeting started at the Great Hall of the People, just 2 kilometers away from where I'm standing outside the Forbidden City, and they struck a positive tone to start things with. President Xi said that China and the U.S. must jointly answer questions of the times, and said he expects 2026 to be a historic and landmark year for U.S.-China relations. Let's listen to what he told Trump.
I always believe that our 2 countries have more common interests than differences. Success in one is an opportunity for the other. And a stable bilateral relationship is good for the world.
And President Trump also told President Xi, talking about their long relationship, as this is, of course, his second term now. The last time a U.S. president visited China 9 years ago was also by President Trump. And he said, no other presidents have had such a long relationship. And he said he looks forward to doing business again in a reciprocal way. And he also told Xi that he is honored to be his friend. So let's take a listen.
It's an honor to be with you. It's an honor to be your friend. And the relationship between China and the USA is going to be better than ever before.
And it's not just these two leaders meeting, of course. We have the CEO, some of the most powerful American tech business executives joining President Trump. We saw them shaking hands with the two leaders outside the Great Hall of the People earlier. And we also saw Jensen Huang standing there just behind Marco Rubio earlier. And Elon Musk as well of Tesla also here. And he says that he wants to accomplish many good things while he is here. And NVIDIA CEO also said the meetings went excellent. So we're seeing Trump talking up the business deals that could be in the making, billions or even hundreds of billions of dollars potentially in the works with this delegation here. So we'll be watching what kinds of agreements could come out.
We're all watching for what kind of agreements come out, and there perhaps will be more than just symbolism and photo ops. But we'll get into a break. On the other side, we'll come back with pre-opening. We'll also discuss oil marketing companies. ICICI Securities' Probal Sen joins in next. Welcome back. Counting down to the open. Let's get you a few technical trading ideas. Mitesh Thakkar, Sudarshan Sukhani join us as always. Good morning, gentlemen. Thank you very much for joining in. Sudarshan, let me begin with you. What's the call on the Nifty Bank?
Yeah, good morning. Well, yesterday we did see a low that was made at 23,250, 260 actually, and then a bounce from there. Maybe, and the key word here is maybe, this could be a short-term low. And we've found some support here. It's not yet very clear, but there's a trade on the long side that's worth taking. We know exactly where we want to exit, below 23,250. So with that as a stop loss, look for a small intraday dip towards maybe 23,425 to 450, that small zone, and then go long. Your stops are very clear, but I would take a long trade on the assumption that perhaps yesterday's dip was a low.
Mitesh, would you concur that the low that we had yesterday acts as a firm support?
I'm not very sure of that, to be very honest. I think that the Nifty, broadly is negative. But yesterday was a movement which is slightly counter trend in the sense that after 4 days of decline of about 1,200 points, there will be an attempt to pull back. So in the short term, 1-2 days, maybe yes, you will still have those pullbacks playing it out. But till we start getting past 23,750, 800 zones, I think the broader tone will be still on the negative side. So in that sense, I think, I would be looking at more of shorting opportunities once we get closer to about 23,700, 750, 800 zones.
Let's talk stocks then. Mitesh, what would you go with?
See, on the stock side, I have a few buy calls today, given the fact that one, the GIFT Nifty is slightly on the positive side, and two, I think that pullback might soon play out. So I have a buy on, the first stock which I have is Cipla. Cipla is a buy. Just can you allow me for a minute? I think the document is failed to load properly. I just exclude.
We'll come back to you for the Cipla rates and the numbers. But Sudarshan, you want to tell us your stocks?
Yes, Grasim is a buy with a stop under 28.90. It's not just for today, it's also a positional buy. Tata Steel is a buy with a stop under 215. I have two short selling ideas because, as I said, we assume that the Nifty has made a low, but you never know. Sammaan Capital is a sell with a stop above 145, and KEI is a sell with a stop above 5,000.
Mitesh, can we come back to you?
Yeah. Cipla is a buy with a stop at 1309 for targets of 1365. Also a buy on Hindalco with a stop at 1049 for targets of 1120. A buy on Manappuram with a stop at 303 for targets of 330, 322. And one Selcon, that's Eicher Motors, which I would recommend selling with a stop at 70.50 or just above it, and a target of 6,800 is what I'm.
All right, we'll come back to you for more calls at 9:10. For now, let's turn our attention to the oil and gas space because geopolitical tensions continue to keep Brent crude prices at elevated levels. Yesterday, the IEA, the International Energy Agency, turned notably more cautious on the global oil market in their latest report. Back home, the focus is now the impact that we will have on oil marketing companies. Yesterday, HPCL came out with the numbers. The Q4 numbers were good, but the street is worried about the kind of losses they are currently incurring on LPG and auto fuel. And will we see some sort of a government intervention, maybe a fuel price hike? So lots to discuss. Let me invite on the show Probal Sen, oil and gas analyst at ICICI Securities. Probal, morning. Thank you for joining in. So HPCL was the first of the oil marketing companies to report their numbers. Q4 is in hindsight. What do you expect from HPCL and the rest of the OMCs till we have some sort of a government intervention, and your thoughts on what's going on?
I think that's the key word that you mentioned, till the government intervention. At the end of the day, I think there is a clear acknowledgement even by the OMCs that losses are obviously piling up. There are different reports, so I don't want to get into what numbers actually one should assume. We have built in a significant amount of loss for the first quarter. In fact, in our revised estimates, FY27 shows a better loss, because, we have not assumed any pricing action at this point of time. And the dispute resolution, as and when it happens, what we assume in our revised numbers is that by H2 things might normalize, but the revival of profitability in the second half may not be enough to offset the losses in the first half. Again, I reiterate that we have not assumed any price hikes or any huge moderation in prices overall over the next 3 to 6 months. So in that situation, my sense is that profitability for OMCs will definitely be under stress. I think two positives that are relevant to highlight here is that HPCL has been well ahead of its own targets in respect to deleveraging, thanks to higher profitability, better operational efficiency, the kind of OPEX savings programs that have actually worked and have actually exceeded their initial targets for FY26 as per the management guidance. All of that has meant that debt equity is at now 0.8, among the lowest it has been, despite the kind of capex they have done on the Vizag expansion as well as the Rajasthan refinery, which is, I think, extremely creditable. And that, in an ironic way, does provide some cover for bearing losses for a slightly longer period of time than earlier crisis occasions. If you go back to 2008 financial crisis, the COVID situation, or the beginning of the Russia-Ukraine conflict. So what the government will actually do with respect to its pricing actions or in consultation with the boards of the respective OMCs is something that's uncertain. And therefore, we have turned fairly cautious on the space at this point of time.
What will be the losses in Q1, assuming crude prices stay where they are and there is no intervention?
If there is no intervention and crude prices stay like this and losses continue to be this high, which is close to about more than 10 rupees for petrol and close to 22 rupees for diesel, the losses could be, fairly significant. I have not, published Q1 estimates specifically, so won't be comfortable discussing it. But our FY27 loss estimate as of now stands at 20,000 crores for HPCL.
Got it. Prabal, good morning. On the product side for refiners, what's the environment like? You keep hearing one or the other. I think last night the 7th largest Russian refinery was up in flames. I mean, so generally refining margins seem to be still holding pretty strong, right? Diesel, aviation fuel, etc.
Oh, absolutely. I think the product cracks being this high is one of the reasons why losses are also accelerating, because you've also got, from as per various reports, some sort of a capping in terms of the refinery transfer price to the marketing divisions, as well as the higher export taxes that are in place, to sort of keep exports uncompetitive against domestic sales. But if you look at the theoretical margins, more than about 1.8 million barrels a day of capacity has been knocked out in the Middle East alone as part of the conflict, and as a trickle-down effect as part of the Russia-Ukraine conflict. There's been more refining capacity that has actually been impacted. So various estimates suggest that close to 3 million barrels a day of refining capacity is actually affected over the last 6 months or so, which obviously provides a lot more tightness in the market, quite apart from the flows that have been restricted due to the Strait of Hormuz. So my sense is that margins.
Chennai Petro and MRPL standalone refiners will not make money because they are also capped. What they can make.
Obviously, we don't know the exact levels for each date in terms of what the capping is. But yes, obviously, if product spreads themselves are actually being fixed at a certain level, then they will, I think, excuse me, the numbers suggest that margins will still be higher than historical levels, but they will not be what your Excel sheet suggests, let's say. On a theoretical basis.
You should not price those numbers into well put. Now, for Reliance, though, what does it mean?
I think for Reliance, even with all the restrictions and, whatever has been going on in terms of capping, the fact is, again, that GRMs will probably definitely be higher than what they were for FY25 or so. That would be our sense, number one. Number two, the supply tightness is also spreading to the petrochemical sector, and Reliance has the advantage of building in a strong pipeline of multiple inputs for its petchem. Unlike some of the other refiners who rely on naphtha, Reliance, obviously, as you would know, has a pipeline of ethane, which is anywhere between 35 to 40% of its petchem output, plus the refinery of gas cracker that it has. So naphtha-based cracking, which is the most unprofitable today, is actually less than 22-23% of its overall portfolio. So if you look at its OTC segment overall, my sense is that numbers can actually continue to recover over the next couple of quarters unless some fresh restrictions are placed or there is a constraint in terms of crude supply itself, which from what we understand at least is not evident as of now, at least over May and June.
Prabal, the other development was the government cutting the royalty rates on production of oil and gas, which is positive for ONGC and Oil India. Share your thoughts on that. You turn cautious, incrementally more cautious on oil marketing companies. Does this development make you incrementally more positive?
On upstream, absolutely. I think what has been remarkable is that as of now, we have again not seen any moves in terms of capping realizations for both these companies. And on top of that, the kind of royalty reductions that have been done specifically for the onshore fields, nominated fields, close to about 6%, savings that will be evident on the onshore fields. That will definitely benefit Oil India relatively more than ONGC. ONGC probably has maybe about 20-30% of its production coming through from onshore compared to close maybe almost 95 to 98% for Oil India. So to that extent, I think the benefit is more for Oil India versus ONGC. Having said that, in terms of valuations, what we really see is that if you do a reverse DCF, I think ONGC's valuation still factor in a less than $70 price deck over the medium term, whereas Oil India, I think, has outperformed, and probably factors in closer to $80, $82. So in terms of preference, we would continue to believe ONGC versus Oil India at this point of time.
All right, Prabal, we'll leave it there. Thank you very much for joining us. Good speaking with you and appreciate your time here as we take stock of what the call is as far as the entire oil complex is concerned. Well, I think it's 9:10. So Sudarshan and Mitesh are with us with the 9:10 call. Sudarshan, what do you have?
It's Grasim, buy Grasim with a stop under 28.90.
Mitesh, what about you?
Go with the buy on Manappuram for targets of 322 and a stop place below 303.
Which was the stock?
Manappuram.
Manappuram. Got that. Thanks very much, both of you, for those calls. Let's just look at the dollar rupee, and if it's made a new low, we got to 95.80 yesterday, 95.71, 75. So it's a flattish kind of start, and 5 minutes to go for markets open here as well. Bharti is we're going to shine the spotlight on once again. So the stock in the pre-open will come up, but Rima will take us through the details. Rima.
Well, Bharti Airtel has been an underperformer. Year to date, Bharti Airtel is down 13% because the tariff hike were not coming through. Things were slow. And then came the announcement 2 days back that the company will consider reorganizing the shareholders. So immediately, the market jumped on to the expectation that Bharti Airtel will acquire the promoter entity stake in Airtel Africa. And the street was worried because if they had to acquire that 16% stake, because the management had hinted about it in the past, there would be an overall outgo of nearly 28,000 crore rupees. More than, so that's a sizable amount. So the street was worried. In fact, over the last couple of days, yesterday itself, the stock had hit a fresh 52-week low of 1740. But I think today the street is taking a more positive view because on that deal, on expected lines, Bharti Airtel, the listed entity, has acquired a 16% stake in Airtel Africa. That's the Africa business from the promoter entity. With this, Airtel, the listed Airtel stake in Airtel Africa goes up to 79%. But this is going to happen via a share swap. Bharti Airtel will issue some preferential issue, and that's going to come in at a 9.5% premium to where the stock closed yesterday, above the 1,900 rupee mark. So the street is overall, sanguine about it. They're saying it's fine, and the company themselves are saying that it will be an EPS accretive transaction from year one. So those concerns are allayed, and as I said, the stock has been a rank underperformer, 13% lower from the start of the year. So you are seeing that rebound. Purely on Q4 numbers, on the India mobile side, it's been a bit subdued, but India mobile is only 50% of their overall revenue. The other 50% is actually doing pretty well, whether it's Africa, whether it's homes, whether it's the B2B business, which is why the consolidated numbers have come in line with expectations. So some rebound visible in Airtel. Even yesterday, stock was actually a little higher by the close. And this morning, I think in pre-opening, it's adding on some more. But Sonal is now joining in. She's here with us in the studio on Oil India.
Well, yes, good set of numbers reported by Oil India, but that is something which was expected because crude oil prices were higher, and that is something that we can see in the numbers as well. Revenue is up 21% on a sequential basis. EBITDA has risen as well to levels of 1,820 crore rupees. Margins have expanded by 300 basis points, and profits have almost doubled to levels of 1,789 crore rupees. Crude oil realizations are higher for them at $74.46 per barrel, which is an increase of 5%. And more importantly, the production has gone higher as well for crude oil by 6% on a YOY basis. Additionally, the tailwind of royalty cut for crude and gas production is something that is positive for Oil India. Crude prices continue to be higher and rupee continues to depreciate. All of these things are fundamentally positive for Oil India.
All right, Sonal, thanks very much for that. Well, a quick recap of stuff which we've covered since the morning at 8 o'clock. Bharti, of course. Oil India, so two names we've discussed just right now, 2.5 and 3.6 respectively. Bharti Hexacom is up about 2.25%. NLC India will come up about 7% higher. Crompton is flattish higher. IKS 4% up in terms of the rate. There is Zydus Life, there is Tata Motors commercial vehicle, there is Keynes, which of course is the casualty of the day with the numbers, the poor performance, 10% lower on Keynes. The recent lows on Keynes were about 3,300 or so. So, perhaps should get to it by today. I mean, sometime today. Balrampur Chini, Sri Renuka, Dhampur, and the sugar news coming through post-market hours yesterday as well. So, sugar exports disallowed, except, of course, what's already been contracted, as Manisha told us just a while back. We've got market open with the first rates up on your screen. We'll look at those and then look at individual names in a bit. So the first rates are coming up. It's 0.6% pop, almost 0.61 actually. 23,556. The Nifty Bank is up 0.6 as well. The small cap index is up 1/3%. The mid cap index is starting higher. So it's a decent start all told. 150, and we're back at about 23,560. The resistance is 23,800. Which was the support earlier. We are ranged, but we get these occasional 100, 150 odd point moves. Let's see if it fizzles out or we're able to hold on to it. The Nifty heat map gives you a quick sense of where we are starting on the Nifty 50 stocks before we move any further. There is TechM, TCS, HCL. Oh boy, it's all, it's 4 IT names and 1 steel. And that's the 5 stocks which are down on the 50 stock index. Cipla, Adani Enterprises, Adani Ports are higher. By the way, if you look at Adani stocks yesterday, Enterprises, Ports, Energy Solutions, Green, they were some of the biggest gainers in trade yesterday. So there is that which is happening. And of course, that big block happened in Enterprises, just as we reported a little while back. Rima.
Well, Bharti Hexacom are the two stocks in the green. So Bharti Airtel has opened up with a gain of 1.3%. So adding on to the rally that we had yesterday, 18.20 on Bharti Airtel right now. Cipla is your top gainer. It's a 7% move. Came out with numbers yesterday. Initially, profits plunged. Then the street did that one-time adjustment. And the stock is rallying in how? Very large volume, 7.5% on Cipla. Clearly the top gainer by a margin. Adani Group stocks are higher. Adani Enterprises, Adani Ports, seeing buying. Power Grid in the green. HDFC Life, Tata Consumer, Coal India, L&T. So lots of stocks on the way up, but as Prashant pointed out, on the way down, it's all IT. And these stocks continue to slide. This week, in the last 4 trading sessions, Tech Mahindra, TCS and HCL Tech have fallen between 5 and 7% respectively. So no respite. It's fresh 52-week lows on TCS today. It's fresh 52-week lows on HCL Tech and Infosys. In fact, they are at 3-year lows, not just 52-week lows, but the slide continues. And this is despite their 1.2%. You know, earlier there was always a positive correlation. Every time Nasdaq did well, and we would say there would be a rub-off impact on Indian IT. And now somehow it's the reverse. Nasdaq was up 1.2% yesterday. But Indian IT is under pressure.
Well, Reem, a few stocks on the broader markets that deserve special mention. Care Ratings, they delivered a big net profit of close to around 53 crores. That compares with around 43 crores on a year-on-year basis. And I think there was some margin expansion as well. Came in at around 46.5%. That compares with around 43%. So big up move is what you're seeing in Care in initial trade. I think the stock is up close to around 8%. It's flying away. Volume's not very, very high, but that stock is up and about in trade. Another stock that's catching your attention is Balaji Amines. Just take a look at that stock. Bursting away. Stock is up close to around, I think, 15%. Volume's fairly decent as well for the first 2 minutes of trade. You have the profitability that jumped up, I think, by more than 50%. And the margins were up close to around 480 basis points. So big move is what you're seeing on Balaji Amines. That stock is flying away as we speak. Bagel Projects, they won a 200 to 300 crore 400 kV transmission line order from Power Grid. So that's why that stock is up close to around 7%. Sagar Cements, well, those numbers look quite good. At least they delivered double-digit margins. Remember, it's been a big rank underperformer. On a low base, they have delivered good numbers. Con call schedule later today. Let's see what the commentary is out there. Some kind of tinkering with regard to the debt is going to be important. Otherwise, valuations attractive and margins expansion on that front as well. MTAR Tech, it has rallied, but it says it's good for more because that stock is well up and about in today's trading session. Big move is what you're seeing on that name. I think on the downside, the reaction that is calling for attention is Keynes Technologies. You can't get out. There are pending sell orders. Stock down 10%. Zaggle is down close to around 7%. We'll speak to the management in the next 70 minutes or so. Interarc, I think that's another management that came out with the set of numbers. It's scheduled for some time during the course of the day. So both those two down 7 to around 8%. Net, Nifty is up 140 points. You'll want it to build onto the gains. The breadth of the market is positive as well. The bulls will say, let's pack up. But we've got a full day session to get through.
No, you're absolutely right. It's 140 odd point gains. So it's a pretty good session at this point in time. I think we'll just look at the, maybe a few more names before we go any further. It's, by the way, pretty 5:1 in terms of advances to decline ratio at this stage. MTAR continues to, power away. It's another 6% pop at 7,200 MTAR Tech, and we were talking about this one a little while back. The Adani Group stocks are all up between 2, 3, 4%, depending on what you want to look at. I can count enterprises. There is green. There is ports as well, which are all higher right now. RR Kabil has had a decent run last few days. I mean, actually, not more than a decent run. So from late April levels of 1,400, stocks at about $2,000. So it's a pretty sharp run up that we've seen on RR Kabil. Sharda Cropchem reported numbers a little while yesterday, actually, on the last hour. Stocks up about 1.5%. Metropolis is up 5%. Just a few other names, right? Whether you're seeing this kind of price action play through. Newland Laboratories has been such a amazing wealth creator. So absolutely bit of an interruption from the highs in November last year. It got to about 12,700 or so, which was the low. That was the low in March of 2000 this year. And from there is rallied right back to almost back to 17,000 kind of levels. E2E is the other one, which is up about 3.5% right now. So there is enough and more, which is playing out. Quality Power is down 9%. So that is, one name. Apart from Keynes, Quality is the other one, which is down sharply. Maybe a TVS Motor is down, which is down about 2.5% right now. So yeah, that's where there is some pressure. Otherwise, I mean, it's a pretty decent session. We have Manishira Chaudhary with us with Emma Capital Partners. Manishi, good to have you with us here. Thanks for joining in. If you will, there is, if you've looked, you obviously track Bloom Energy in the US, right? And I'm sort of linking that back to the listed player here, which is MTAR Tech. And Bloom is... No, you don't track it, Manishi?
Not really.
Not really. Okay, no. Okay. So yeah, I mean, Bloom provides power to data centers, and MTAR provides fuel cells to Bloom. So that's the connection. And of course, I mean, with everything which is happening in the US, this explosion of demand for power for data centers. I mean, I think MTAR is getting lots and lots of orders. So it's done phenomenally well. So tell us what's on your radar, because, you know, money is being made. It's just that it's a narrow set. Moves are very, very sharp. And as earlier guest was remarking, every day you look at names like this, it's up another 5%, 6%. So it's very tough to buy. It becomes very tough to buy in that sense. Manishi.
Absolutely. You know, you asked me, I'll go back to your original question, Prashant. What's on my mind? You know, as far as India, or for that matter, any other market is concerned, there's just one thing that investors need to keep on their minds. And that's what I'm focused on. And that's number one, earnings, number two, earnings, number three, earnings. And that is, unfortunately, the biggest disappointment for India right now. You know, that's the big elephant in the room. And there's earnings estimates which are being downgraded every day across sectors in India. And that's the big difference between the other emerging markets, the large emerging markets, and India. You know, you look at the North Asian markets like Korea and Taiwan, people mistakenly say that it's only an AI story. No, they're not. There are earnings estimate upgrades happening across sectors because the AI boom is now percolating down to individual earnings. I mean, you know, the average householder's earnings over there, which is in turn driving consumption sentiment. So look at Korean banks' earnings estimates, look at Taiwanese financials' earnings estimates, look at Korean retail earnings estimate. And that is, you know, what bothers me. You know, everyone laments that FIIs are selling India. They're not selling India without a reason. They're not really finding the large frontline stocks where they can make money and where, you know, there's a positive earnings framework supporting the valuations. And I think, you know, apart from the currency, which has been in the doldrums, this is one of the biggest headwinds for the Indian market right now.
All right. Hi, Manishi. Good morning. Good to see you again. Manishi, but we've gone through a period of underperformance, and there'll be various themes, right, that have started to look up. What would be top of your list out there?
Remember that when I talk about India, these sectors, I'm really talking about maybe a 3-year time frame, not really over the next 1 or 2 quarters. I personally think that the best strategy for Indian investors is to diversify a significant chunk of their portfolio outside India, particularly the Asian emerging markets. So that would be my advice, number one. Within India, we do like the private banks, we do like industrials, we do like consumer discretionaries. For the industrials, at some point of time, I think there would be some kind of a compounding effect of private investments coming back. The Middle East will have to be rebuilt, and we have large companies which have experience and expertise over there. We like consumer discretionaries because, you know, I mean, at some point of time, you know, once we are through with this present round of inflationary concerns, consumer spending would come back. That's still about 60% of the Indian economy. And there are various segments within the consumer space which can be played, not just the four-wheelers, but also some of the diagnostic chains, some of the food delivery companies, some of the new e-commerce companies, and so on. You know, but those are the 3 main segments I would look at. I'm also looking closely at the base metals, you know, like the steel and zinc. They are the only ones which have had some kind of earnings upgrades. The valuations are still very reasonable over there. So that really summarizes my point of view about India. But remember, to make significant returns on these sectors, one would have to wait for maybe, maybe 1 year or maybe 1 to 3 years.
So have you brought down your weightage of India in the overall emerging market portfolio right now?
I currently have a neutral stance on India. The Indian weight in MSCI Asia ex Japan is slightly less than 15%. So it's around 14 to 14.5. And that is where my weight in my model portfolio stands. The biggest overweights are Korea, Taiwan, and Hong Kong, China.
But you're saying it will take at least 1 to 2 years, 1 to 3 years before the Indian markets can start generating any sort of a return. And we've already gone through a near 2-year period of low returns, muted returns, lackluster markets. Should one be Yeah.
You're right. I mean, I guess your question is that, aren't we there already where the Indian markets can bounce back? I would be a little more enthusiastic about the Indian markets if the earnings environment improves. It looks like fiscal 27 would also be a single-digit earnings growth year, and we have had that in fiscal 26. We started fiscal 27 with the mid-teens kind of earnings growth expectations. If you go back about 6 to 9 months, it was about 15 to 16%. Today, it's down to about 9.3%. So this is going to be another single-digit earnings growth year. I would also be looking closely at the currency. We have a balance of payments problem. We have a situation where the current account deficit is no longer being neutralized by FDI and foreign portfolio investments. FDI, net FDI, has been close to zero and possibly negative this year. So these are the issues that need to be sorted out before we have a degree of enthusiasm on the part of the foreign institutions about investing in India. Bit of a chicken and egg situation here, but clearly these are the variables one would have to very closely look at.
Okay. All right. Manishi, we appreciate you joining in. Thanks for giving us your brief comments on the Indian markets, the global setup as well. Have a good day ahead, and we catch up soon.
Thank you very much.
Time to focus on the stock of the morning. Kaynes Technology, they have disappointed on all fronts in the past quarter. Revenue, margins, profitability, all of them below street estimates. To help us out with what went on in the past quarter, what's the way ahead, we're joined by Mr. Muthukumar Narayan-Swamy, the Managing Director of the company. Hi, sir. Good morning. Good to speak to you. But investors are really waiting to hear from you. I'll tell you why. We spoke, with the management of Kaynes towards the end of March 2026. And you all had mentioned guidance is on track. Now, the operating cash flows are negative. Revenue has missed the mark as well. Don't you think you all should have given investors a bit of a heads up if there was any kind of issue, particularly towards the last 10 days of March? Why such a big miss, and why couldn't you all alert your investors?
Thank you, Prashant. Thank you for taking me into the call and really appreciate your time early in the morning. Yes, I think during the last call, during the middle of March, we did communicate, and we were looking for 2 major government contracts where we completed the manufacturing to go. But because of the last minute delay on the contract, we could not go immediately. But nevertheless, I wanted to reiterate with you all, for a full year, we have grown by 33%, and our bottom line has grown by 39%, which gives a very, very strong fundamental performance. The organization has been formed with a fundamentally strong product. Yes.
Sir, we have the numbers, sir, with regard to what you have delivered. The question is, when you all were guiding for the cash flows to turn positive and the revenue number to match the guidance, why didn't that happen, sir? It couldn't be a problem of just the last 10 days. You all would have known right on March 20th that this sort of an issue, those contracts haven't come in, or there is some revenue that is deferred. So the clarification is on that front. And also, what is the way ahead now? Will the cash flows turn positive? Point number 1. What kind of revenue guidance will you be targeting for FY27 with margins? Please go ahead.
Thank you for giving this opportunity to explain our position. If you see the market here, the market against India's growth of about 8%, the electronic business is growing at about 15 to 16%. And we are sure in Kaynes that we will be outgrowing the market, and we'll be almost double of the market growth in electronic industry in our peers. So we will be able to get into a FY27 revenue, which is almost double of the market growth in this area. Well, the actual guidance depends. The factory is ready to deliver. The products are up and running, but it all depends on the consumption. In the last quarter, the market situation, particularly post the Middle East war, has created some uncertainties. That was the reason. But going forward with all the OEMs outlook, we are very, very pretty strong on this. In our revenue, which will be doubling the market growth. The actual numbers depends on the consumption of the customer. As long as the cash flow is concerned, I wanted to tell you, there were two businesses with us. One is a electronic EMS business, and second is a product addition called metering business. If you look at the standalone Keynes Technology India Limited, we were positive against about 65 crores of last year. This year, we are at about 255 crores. And our receivables on this segment has substantially improved in terms of the number of days. The net working capital on EMS business has come down to 55 days when compared to 64 days last year. However, the metering business, which is a strategic acquisition for Keynes in order to get into the product segment, which is 25% of the revenue, the business model itself is of a payment over a staggered term. We are working with the agencies to make sure that how we can do it, these things in a much better way. And we are pretty confident in next 3 quarters, we will be able to come back with a better situation than what we have. But I wanted to, you to look at our standalone EMS business, which has created substantial delivery in terms of reduced net working capital.
Yeah, Mr. Swami, hi, morning. This is Prashant here now. This is my colleague Nigel earlier. Just a quick word on because, you know, we had Sirma management with us 2 days back. And they also kind of talked about what they classify the smart meter business in the industrial segment. And they said that they are now going to go very slow and be very cautious on the meter business, smart meter business, because they say there are receivables issue. I mean, actually, and they very explicitly said, I mean, the business is not what it looked like. The opportunity is not what it looked like 2 years back. So they're going to be very selective in terms of who they work with and all that. So is this, and we've heard reports, right, from various states coming through that there are these protests, and generally, I mean, there seems to be a pushback, and that I'm assuming will flow through to SEBs and SEBs in terms of who they purchase from, and then they give you orders. So it's like a full cycle. So is it a temporary issue, or you think you will have to scale back?
Okay. Every organization has their own strategies and their own growth plan. Keynes, which is strong in the manufacturing field, are moving towards a product company. Thereby, we are adding products to our services. We could claim proudly that we are the only company which has got meter manufacturing, meter installation, and of course, meter services also in terms of the software. So we feel that this is one of the strategic acquisitions for us. If you ask about the timeline on this business, yes, we are pretty sure that this has helped us to add up to our bottom line. Because we are selling the products now, but at the same time, we are working on various methodologies to see that in next 3 quarters, how we can convert this into the reversal of the trend. But you can rest assured that this is the business model which is giving on this, and we have taken over this, and we are pretty confident of coming out of this. Of course, we have a very clear strategy to see that how we can mitigate this risk associated with this. But we are pretty confident on this.
Just one more question from my side. What is the revenue growth in FY27 going to be? What is the revenue growth in FY28? If you can just give us those two numbers. Growth for the next 2 years. To your mind, internally, what are you looking at?
While we are, you know, Keynes is a very, very aspirational company and looking at the multiple segments.
So just give us the aspirational number, sir. Internally, what is the aspiration?
See, the industry is looking to grow at about 15 to 16%. We are doubling of that growth. That's what I can share. With the high volatile situation that's around this industry and in India, what is going through, and we are poised to grow in an every growing segment, be it electric vehicle segment or defense segment or industrial business. But at this point in time, rather than telling the number, I would say that we are pretty confident because we have a capacities available, technology available, product available. We'll be outgrowing the market and we are doubling of the market growth.
So I can put out a flash saying Keynes is telling us that revenue will grow 30% in 27 and 30% in 28. I would not be wrong.
You are an awesome, and then you are able to interpret the numbers. What I say, go ahead.
Okay, got it.
Morning, this is Rima here. What was the loss in revenue on account of those 2 government projects which got delayed? And has that come on board? Because you also said consumer demand was soft.
See, it's all in the last minute of when we do the bidding, when the product is ready and the product is already tested and approved. many of the allocations happens at the point of time. We were very optimistic about how we can grow into this and then got it. But unfortunately, what happened is there was delay in this. I don't want to go into which company, which product at this point of time, but we are pretty confident that it is not a lost business or it is only a delayed business and it is not a denied business.
Okay, so that's still not come through then. And you also said that consumer demand has been soft. Is that persisting?
See, consumer demands as soft is one, but if you see the Keynes presence is not in one vertical. We are present in multiple verticals, and we will be able to overcome the softening, the market softness in the consumer by the other segments where we can grow. And that's why I always put it up saying that the market volatility, keeping it aside, we will be outgrowing the market and we are double of the market growth. That will be our penetration into the market.
Okay. And on margins, you ended Q4 with 15.8% margins. What can we roughly assume margins to be, given all the puts and takes?
Keynes as an organization continues to focus. When the market is volatile, the internal makes us a difference from with our peers. We'll be continuing to expand the market like what we have done last year. And going forward, we'll be, how we have delivered the results when compared to the previous year to this year. We'll continue in the same path of expanding our margins.
17% margins, because you'd spoken about it the last time. So by the end of FY27, you get back to 17%?
I don't want to again mention the percentage, but if you see the growth, what we have got, we'll be going ahead in the same number.
You know, sir, the EMS market, you're mentioning it will grow at 15%, but I think it will grow at 20-25%, right? That's what the street is working with. So in that case, your EMS business should grow at around 35 to 40%. Fair to assume?
I think you are right. I just wanted to little give here. Even the metering business, we were doing the EMS part of it earlier. So the entire revenue, what you are seeing as a metering business today after consolidation, more than 50 to 60% were the EMS business that we have been doing earlier.
Okay.
So it is not that the entire growth has come from this business. We already have been owning this business just for bringing it to this. So the EMS business is growing at about 30%. You're right.
Yeah, so then you will be outpacing that, right? So 30% will be conservative. You should be growing at 35 to 40%. The reason I ask you this, sir, is because earlier the management of Keynes, when you all joined us, you all had said that in the coming year you'll do around 5,500 to 6,000 crores of EMS business. OSAT revenues could be around 1,000 crores, and the bare PCB revenues could be around 500 crores in FY27. All these numbers look more or less in line?
Sir, I don't want to again go into this. The bare PCB revenue, if at all we are going to consume internally for our own manufacturing, it will be completely it's a game changer. It will add up to the bottom line. So I would always maybe not a conservatively, but I always put it up in such a way that we'll be outgrowing the market. If the market is growing at 15%, yes, we'll be doubling the growth.
And that $1 billion target by FY28, that's still in line for the following year?
I think 28, 29, I think we are on target and but the dollar, it's a very tricky numbers today because of the depreciation that happened. But of course, in terms of Indian rupees, what we have communicated here.
Okay. All right. The order book, sir, let's focus on that. The book to bill ratio, that's around 2.3x odd. That's the lowest we have seen all the way since listing. Your order inflow in the past quarter was only around 530 crores, which is sharply down, right? Were there cancellations or is there some kind of deferment or just some simple delays which will actually start coming back? And last quarter was a bit of an aberration.
I said it is not a denied order, it's only a delayed order. And we have the products ready, we have the testings done, and it's a question of launching.
And delay from where, sir? Which segment?
As I said, two of the contract projects with the specific with the government business, what we were looking at, there's a little delay in terms of the approving and then clearing the project.
The meter business, that's the meter side.
Yeah, you are right.
So again, just to in 27, what is as Nigel said? I mean, I gave the numbers. So order inflow growth is 25%. Average order inflow growth used to be 50%. So in FY27, what over 26 in terms of ordering, what kind of growth can we expect? I mean, of course, as far as you can see, it's not all in your control, and we may see delays. But what do you see?
I would say that our order book on hand is almost the same or on the same levels of what we had started with last year. That are a little more than that, I would say. So we have a lot of pipeline orders that's available. But I want to be a little cautious in the first quarter to see that how market is reacting to the volatility. And then we'll be able to give a right number by end of the first quarter. We are talking to all our customers. to see that how the market is. To mitigate, if at all there is going to be any market drop, we are also looking at outside the country to see that how we can expand, not only in this business, also in the metering business. And of course, you know that in third and fourth quarter, I think we'll also get our PCBs and OSAT facility up in operation full swing. We are currently working on a strategy, whether it is going to be for internal consumptions or how much we are going to do outside. All these things will decide on how the end of the year number is going to be.
Sir, and one final question. Based on the visibility that you have, when do you think you can turn operating cash flow positive?
As I said, for as far as the Keynes Technology India Limited, the parent company, we're already cash positive. In terms of the metering business, you all need to appreciate that the business model itself is like that. But by end of the third quarter, we'll be reversing the trend and we'll be getting into the, I can't say positive, but at least we'll neutral.
Okay. All right. So final question. If I look at it, your operating cash flows are negative. Your working capital cycle is getting a little bit elongated. What is the cash in your books, sir, and how will you fund this growth? Because you're not throwing up any, operating cash flows.
As an operating cash flow, we are working on both the sides. One is reducing the inventory from our side, working with our supplier base to expand the time. And of course, we are also working on collections from the customer. Yes, metering business as an operation for us, because it's a business model that we acquired. It has given us in a different results in terms of moving up in terms of our profitability, in terms of a gross margin, in terms of our converting us into a product company, which makes the organization very, very strong in terms of our confidence in launching more and more products. So we have a mitigation plan to come out of this, and you will see in the coming quarters how we are going to be positive on this.
Okay, all right. Sir, will you be looking at raising any kind of cash? Any kind of money from the market?
I think not in the immediate next 2 to 3 quarters.
And cash in books is 800 crores, right?
Just to clarify, the dollar, because the rate of depreciation has been so sharp, what was the dollar rupee when you gave that $1 billion guidance first, sir?
We had at 82.5 or something, sir.
I mean, 82.5 and we are at 90, almost 96 now, right? So maybe you want to quantify a rupee value guidance and not leave it to the dollar rupee.
I know that even Indian GDP is measured in the dollars, but we will keep our options and we'll keep our hopes positively.
Yeah, no, absolutely. Thank you very much. Good speaking with you and good luck executing. We will catch up again.
Thank you very much and thanks for taking me into the call. Really appreciate it. Have a great day.
Thank you. You too. Well, I think we just want to focus on Keynes, of course. I think it's picked up a little bit, maybe, but dropped quite sharply. 34.83 and 17% lower right now. Zydus Life is what we want to focus on. And Ekta is here with details. I think the stock's up. Ekta, take it away.
Well, yes, Zydus has joined Sun Pharma in terms of making an acquisition in the US in the past recent few weeks, but obviously the size differs. Nonetheless, they will be acquiring Assertio Holdings for around $23.5 per share, which equals to $166.4 million in an all-cash deal. Now, Assertio is basically a US specialty oncology company. And it has one of its portfolio includes an oncology drug, which is basically called Rolvedon, which the market is quite positive on. They've already received a biological license application or BLA from the US FDA for this particular drug. Now, separately, this acquisition is going to be via a tender offer, followed by a merger of Zara, which is Zydus' arm, into Assertio. Assertio will be the only surviving entity, and eventually it will be delisted from the NASDAQ. CY's 25 sales have been positive for the company, $68.23 million versus $60 million on a year-on-year basis. So overall, analysts are working with the fact that it is going to be an EPS accretive acquisition, possibly in the first year, and eventually it should add around 4 to 5% of EPS. Zydus Life is also going to consider a buyback on the 19th of May when they meet to for their Q4 numbers. So that is another trigger which the street will be watching out for.
All right. Ekta, thank you very much for that. That's an exclusive story which is breaking at the bottom of the screen. Let's stay with this for and get you more details. So TVS Group is set to buy a near 10% stake in Jana Small Finance Bank. And TVS Group is likely to pay between 450 to 500 crores. We put this, Nimesh had put this out on D Street Chatter, I think 2 or 3 days back. And I think this is now starting to come through. Stock starting to move up as we speak. Jana Small Finance Bank has got a fair number of, I mean, if you look at the shareholding pattern of Jana, it's got lots of institutions. It's got, I think PE investors. It's got some HNIs. I mean, it's a fairly distributed shareholding as far as the company is concerned already. It's not as if, it's a change of ownership from one concentrated set of individuals to, a group like TVS, but it is coming through. I mean, TVS Group now looking to pick up 10%, just under 10%, 9.99% stake in Jana Small Finance Bank. That is the news which is coming in. RBI approval will be needed, and I think there was a bit about that as well. Capital raised to aid expansion and future growth plans. So this, I'm assuming, is a pref issue. Money goes into the company, and that's the preferential issue. So money goes into the company, which is essentially going to be used as growth capital. And I just want to look at the RBI approval. There was a bit about the RBI approval as well. So board is going to consider the fundraise soon, and we of course have written to both TVS and Jana, and we are awaiting response. 18th of May is when the board is going to consider the fundraising proposal, which is 4 days from now.
Well, the stock is up 30% in the last 1 month, so that's the reason why it's not flying away.
No, and also, it's a very, as I said, it's a very, very distributed shareholding. And I think what Nimesh had reported was this 10%, and perhaps there's another 5% coming up as well. So maybe, the plan perhaps is to go up to about 15%. So we'll see if there is more to this, but what we can confirm and what we are picking up, and this is an exclusive, is there is just under a 10% stake, which is in play on this one. So that is the picture on Jana Small Finance Bank. We will have, our team join us with more in a bit. Well, I think let's move on to the next management. Vinati Organics reported a mixed set of fourth quarter numbers. Revenues and EBITDA were under pressure. We have Vinati Saraf Mutreja, Managing Director at the company, joining in. Vinati, good to have you with us here. Good morning. Thanks for being here. Revenue growth has been flat, Vinati. Can you give us a breakup of the performance category-wise, ATBS, IBB, IB, etc.?
Yes, absolutely. Couple of reasons for the flat revenue growth. Starting with ATBS, we did complete the expansion this year in October. However, from the demand side, there was a bit of a slowdown starting October itself, which fortunately has picked up in April. Hence, on ATBS volumes, as per projections, maybe we were down by just about 5% or 10%. Again, I'm going to insist on volumes because bit of the reason, a small reason also why revenues are flattish is because overall this year, the RMC cost was lower than last year, the raw material price per kg. And that also means our realization was slightly lower, even though there was volume growth coming to products like antioxidants, where we saw a 25% volume growth. IB was flat. IBB was also flat. We were expecting some revenue from the subsidiary, where we have realized that since we went for a new process, we are going to have to re-engineer that process, and that will take another 6 months. So we lost about 5% of expected revenue on that regard also.
Hi. Thank you very much, Viniti, for joining in. So for FY26, could you tell us what was the volume growth? What was the impact on account of lower realizations? And for FY27, what is your own expectations for volume growth across the various products?
Sure. For FY27, now that the ATBS expansion is in full, is ready, and also the demand is picking up, I expect about at least 20% volume growth in ATBS itself. I expect revenues coming from the subsidiary starting October 26. Also, antioxidants, the market is looking good. I'm expecting another 15% of revenue growth there. Yes, IBB and IB, butyl phenols, we are already running at full capacity. Net, this should result in a 15% volume growth for FY27.
Okay. And margins for you, you've pretty much said over the 3 years, the 26 to 27 kind of margin band is what you're looking to sustain. Now, in Q4, you did better at 29%. Would you look to raise your margin guidance at least for FY27?
No, again, this margin is a misnomer because when the RMC prices are low and my price falls, the margin looks better because it's a percentage of the revenue, right? And that is why you're seeing the 3 basis point increase from 26 to 29. I don't know what the RMCs is going to look like over the next 1 year. I don't know what the rupee is going to look like over the next 1 year. So I will stick to 26 to 27% EBITDA margin.
And generally, when crude prices are higher, ATBS does, I mean, what is the impact, directionally, if you could help us? And has there been any impact on account of the West Asia crisis? And if you could quantify that.
Well, generally as a, broad thumb rule, yes, when crude prices are higher, ATBS demand goes up. And we are seeing very positive signs for the demand starting April, which also means when crude prices are high, my input prices rise. But thankfully, I'm in a position where I can pass on that price increase in most of my products.
Okay, we leave the conversation here. Viniti, thank you very much for joining in. The rupee, by the way, is trending lower. It's now 95.82 against the dollar at a record low. We opened at the 95.71 or 73, and from there we've slipped a little bit more. Get into a break. On the other side, we'll come back and connect with the management of IKS Health on their Q4 numbers. Stay tuned. Welcome back. Let's invite the management of IKS Health on our show. They reported a strong set of Q4 numbers. Margins expanded by 340 basis points, aided by the equity acquisition. Nithya Balasubramaniam, Group CFO at IKS Health, is now joining in. Nithya, thank you very much for joining in. The margin performance is what the street likes. You had spoken about a mid-30s kind of a margin range. Is 35% what you've clocked in Q4 the floor? Is that the sustainable? Is there headroom to increase it?
I think we've always said that we would be able to sustain margins in the early to mid-30s range. And of course, we did get to that range a little earlier than we had promised the street. So we're, of course, happy about where we are. But I think going forward from now, we would like to maintain our guidance of that early to mid-30s range for IKS. Because as we do see additional operating leverage come through as we scale up our business, we also are looking forward to making the right investments when it comes to our R&D investments, particularly in our AI solutions.
How much do you all typically spend on AI R&D, and how much do you want to increase it to?
So in Q4, it actually amounted to about 5% of revenues. We haven't given a specific guidance on what it's going to look like going forward, but I think you should anticipate that growing right alongside revenue.
And on account of AI, even your contracts that you have with customers moving from input-based to outcome-based metrics and pricing? And if yes, where do you stand right now in that transition?
So IKS has actually been very unique in its business model. We have always had outcome-based pricing. Most of our contracts, we actually make our money based on a take rate, which is X percentage of the customer's net patient revenue. So from that perspective, our pricing model and business model has been rather resilient to the sort of some of the pricing impact that some of the other IT players and BPO players might be seeing.
Nithya, hi, morning. It's a strange thing to do in the middle of the earnings season and the earnings conversation. But for our viewers, right, could you just simply, briefly tell us the business model as it stands right now for IKS?
So what we do in the market is we actually help provider organizations in the US, specifically physician clinics, delegate their what we call chores, which are essentially administrative tasks, which span all the administrative tasks in the front office, the mid office, as well as the back office. So IKS offers them a platform to which they can delegate all of these administrative chores. The way we price our products and services is also, as I mentioned earlier, outcome-based. If you look at our revenues today, about 60% of our revenues, the pricing construct is such that we get a take rate on the net patient revenue of our customer. The remaining about 30%, we actually price it similar to SaaS-based pricing, which is a flat $1 per physician per month. And the remaining is different various pricing constructs. So I think traditionally, even if you go back a decade or so, our pricing model has always been consistently about driving outcomes for the customer and therefore making money based on the outcomes that we're able to drive for our customers.
So you're saying 70% is outcome based. So if the physician clinic does not make money or footfalls fall, your revenues will fall as well. Your earnings will fall. Yeah.
Risk and reward are commensurate. If patient footfalls goes up, so do the money we make. And if there are challenges and therefore patient footfalls go down, we're also exposed to that risk.
Got it. Got it. Your client count has dropped from over 700 in the fourth quarter of FY25. You're about 600 plus now in the last quarter. Is this deliberate reduction? Is this deliberate pruning in that sense? What's happened? And this is a slightly longer time frame.
Entirely intentional. You might remember that we acquired this entity called Equity Solutions in October of 2023.
Yes.
And when we acquired them, we inherited about 800 plus customers. And since then, we have actually been proactively cutting the tail of some of the very small customers where we don't see potential for us to be able to continue to grow and make them substantial. And that's the tail cutting. The impact of the tail cutting is what you're seeing in the number of customers.
Will that continue? So now you're at 600. Will you continue to cut the tail or it's done?
We're almost there, maybe about a couple of quarters, but I think we're almost there.
How is AI changing the kind of contracts that you have with the hospitals and with your end customers? Are they asking you in any way? I get that it's outcome based, 70%, 30% is SaaS based, but are those contracts changing? And if yes, can you tell us how it's changing and internally the kind of savings that you can rake in on account of AI and productivity?
I think AI is, of course, very exciting to talk about. And I think the pace of transformation is quite very different from what we have seen before. But IKS traditionally has been able to leverage technology and take benefit of that operating leverage onto a P&L. So even if you go back several years, you'll always see meaningful non-linearity between revenue growth and employee growth, which is driven by the technology that we've been able to deploy. So more recently, our conversations very different with our customers, not really. I think our outcome-based pricing and the fact that we are accountable for the outcomes that the customer actually cares about is why we've been able to continuously deploy technology and take benefit of it onto our P&L. But of course, over a longer run, we've always seen some amount of benefits, some amount of those benefits being passed along to the customer. We do believe that that'll happen with this new wave of technology as well. We are not seeing any meaningful near-term impact, but I think over a period of time, you will see that impact.
Even on the SaaS-based part of your business?
I think it's true in both parts of the business.
In FY27, will you do 20% growth again?
So one, we're looking forward to the TrueBridge acquisition, closing the TrueBridge acquisition that we announced. It is a pretty substantial acquisition. So I think all the guidance, etc., everything will, of course, have to be updated once that acquisition closes. And when we announce the acquisition, what we put out there for the market is what we're calling our True North. We are talking about in the FY30 timeframe being able to triple our EBITDA. From the current run rate of about 1,000 crores, we are hoping to be at 3,000 crores. And in the same time frame, we also hope to be able to pare down the debt we'll be assuming quite substantially. Our current net debt position at the end of the last fiscal was about $26 million. And we hope to be able to pare down the debt to similar levels by FY30. So that's the guidance we've put out there.
And this 3,000 crore by FY30, how much of it is on account of TrueBridge?
So this is the guidance I'm giving you is for the pro forma combined entity.
Correct. Okay.
So FY23 to 25, you tripled the top line. Not to triple, maybe 2.5 times top line. And now 26, there's another big acquisition. That was the acquisition then, and there's this acquisition now. So you jump again over the, this is slightly longer, but over the next 3 years to FY30, you said, right? Triple EBITDA.
That's correct.
Okay. And leverage? You said the focus is also on bringing down leverage. So once you close it, what will the leverage look like and when will you pare it down? Because you did spend some time to bring it down even earlier.
That is true. So our leverage does go up to about 3x of EBITDA once the acquisition goes through and we draw down the debt. I think our confidence stems from our experience with equity, our ability to be able to transform the business model and drive meaningful cash generation. When we acquired equity, again, we had assumed about $120 million of debt, which we were able to pare down to quite insignificant levels in 2 years. So we hope to be able to bring to bear that experience with TrueBridge acquisition as well.
So in 2 years, you can bring it down, net debt to EBITDA from 3x down to sub 1x? I mean, give us some...
I think I'll stick to the guidance that we gave along with the EBITDA, which is that by FY30, we should be able to pare down net debt levels to the levels that we enjoy today, which is about, I think, net debt is about $26 million.
Unfair question, Nithya, but if I were to ask you to be an analyst on your own company, as you would have done in your earlier avatar, you know, because the shares come up, I mean, it's sold off hard and it's come up to where it is. But, you know, the listing happened at about 1900 and, you know, years in 2000, I think December 24, right? So what's going to be for shareholders, what's going to be the inflection point in your opinion? You're doing the acquisitions, numbers are coming, margins are holding as well. For shareholders, what should they watch out for? What's going to be the inflection point?
See, I think I genuinely won't be able to comment about the share price, and as management, I think our responsibility is to make sure that we deliver on the growth that we are promising and be able to continuously expand the returns to the shareholders, which I think we have been able to do since our listing. And if you look at the True North guidance that we did, that I just mentioned with TrueBridge in the mix, I think that should be substantial shareholder value creation. And I think shareholders should, of course, hold us accountable for these numbers that we have committed to. And I think what I'm hoping will continue to unlock value for them is as we achieve the synergies and the targets that we have set out for ourselves.
Okay. All right. We'll leave you to it, not pushing forward. I understand you can say what you can say, but not more. Thank you very much for joining us. Good speaking with you. And we will keep getting an update from you. Markets, by the way, have sold off quite hard. We've cut the gains in half, 150 points and now 70 points. So that's what I'm talking about. Yeah. So from the highs, which is basically about 30 minutes back, we are back at about 23,480. Shilpa Raut is with us. Shilpa, what trades are you advising?
Good morning, Prashant, Reeman. Thank you for having me on the show. If about the view on indices, we see that 23,200 acting as a good support and Bank Nifty quite 53,000. So as long as holding these levels, we are good to see some sort of respite or short bounce happening towards 25,000, 23,000, and for Bank Nifty 54,500. So this is the setup for indices. Talking about stocks, I have a buy on ONGC. ONGC also has given a good breakout, running above 300-year short bounce. At levels of 315, you can go long here with a stop 285. The other one would be a buy in NMDC. NMDC also a good breakout above 90. So keep a stop loss of 89 and levels of 95 to 98.
Got it. Okay, all right, Shilpa. Thanks a lot for joining and giving us that view. Well, today things will get even more exciting because we'll have the sensex weekly expiry that will play out, particularly in the final hour of trade. Expect some volatility on that front. Let's pull up a few strikes for you, though. In today's trading session, even though the markets are higher, even we were up more, on the sensex itself, when we were up close to 250, 300 points, the call premiums actually are seeing a bit of a decline. And if you look at it in today's trading session as well, the call premium is down by close to around 45%. So directionally, you've got it correct. But the premium has come down from around 209 all the way to around 117 rupees, or telling you call writers are at play. If you look at the put side, though, there is some hope because there is writing being seen at lower levels. The 74,500 put, the premium at the start of today was around 240 rupees. That's come down to around 130 rupees. So if you just punch that in, those writers, they are playing that 74,250 level on the sensex will actually get defended. At lower levels as well, there is some writing being seen. 74,000 put, a little bit of a mix of activity because the premium has come down from around 110 to around that 35 rupee odd mark. So there's a mix of activity. In case things go horribly wrong from here, then those put buyers will make money. But otherwise, the smarter money looks like they're writing that particular stride. It appears the structure is still more or less weakish because the Sensex is trading way below both the 50, which is the first reference point on the upside as that graphic place is telling you. And then we'll be looking at the blue line, which is the 20 DMA. So we're close to around 1,500 points away from those levels. Keep an eye out on that. For the time being, the call writers, they look like they were going to defend the 75,250 odd mark, while on the downside, the put writers, they are hoping that this level of around 74,250 does hold out. Sensex weekly expiry, keep an eye out, particularly towards the end of trade. Well, we'll slip into a short break. On the other side, we'll turn our attention back to commodities. Manisha Gupta will be joining in.
Welcome back. Let's talk commodities now. Manisha is joining in as always. Manisha.
Well, thank you so much for that. I'm looking at sugar today because, one, we have a notification that came in late last night, and that is making an impact not just on the sugar prices in India, but in the global markets as well. India, remember, is the second largest consumer of sugar after Brazil, and those numbers do really have an impact. This is after the Indian government has put out a notification suggesting that they are banning exports till September 2026 for raws, for white, and for refined sugar as well. And this is happening with an immediate effect. There is a caution, where it says that they will allow all shipments which are already in export pipeline under specified conditions therein. So why is India banning export of sugar? Well, that is the question we're answering for you right now. We are looking at crop estimates lower than anticipated at 27.5 million tons. Earlier estimates, because of the sowing numbers were so great, were at around 33 million tons as well. But in the last 3 or 4 months, we have had various associations continue to revise it on the lower side. This is on the back of erratic weather, that unseasonal rainfall that we saw, and also because of the lower yields in Karnataka and Maharashtra has made the overall crop numbers suffer. And then for this season as well, there are El Nino concerns, and that could disrupt the year's monsoon and, of course, the sowing going ahead when it comes to cane. Apart from that, it also is about the closing stock. So when we started this year, it was at around 5 to 8 lakh tons is what the market believed. But now it seems much lower than that. And overall, 15 lakh tons of sugar export is what the government has allowed. But from that as well, it is only about 7 to 8 lakh tons that has been contracted or exported. So you have 6.5 to 7 lakh tons still remaining. And the markets believe that that is what is really going to get impacted. The reaction of this notification from India has been seen in the international markets, where you saw the New York raw sugar prices gained up by 2% and the London white sugar prices gained up by 3% as well. So when you look at the overall Indian exports, and this is what we've done in last couple of years. So this year it was about 8 lakh tons is what we've done till time. That's an estimated figure that we are working with. Last year was 7.7 lakh tons. Government had allowed 10, but India was able to export only 7.7. And year before that, it was nil. The exports for sugar were banned at that point in time. And since then, the last couple of seasons, it has been quota that the Indian government has been giving to the mills there. Also, when you look at the FRP prices there, now I'm coming to the fact that it is not positive for the sugar industry. This is what we've seen in sense of fair and remunerative price increase for cane. This is the price that the sugar mills have to give to farmers for cane. Now, as you can see, in the last many years, it has constantly gone higher. So in last 4 or 5 years, we've come from 290 to 355 rupees a quintal. But when it comes to the sugar MSP, that has not seen a hike since 2018. In 2017 is the first time that the Indian government allowed that or introduced that. And at that point in time, it was at 29. In 2019, 31 is what was increased to. And 2019 to 2026, there has been no hike in this number.
One more thing is about the sugar deficit in the global markets, the reason that you've seen the international sugar prices gain up. So there are reports from Data Growth suggesting that 3.7 million tons of a global deficit is what we are looking at, while 550,000 tons is the number coming in from StoneX. Closure of Strait of Hormuz has curbed around 6% of global sugar trade, but importantly, because of the higher crude oil prices and ethanol being more profitable, a lot of sugar seems to be going in that direction, supporting prices.
Thank you very much for that. The mid-cap index is in the red and lots of stocks under pressure. So Keynes is one, but Zaggle Prepaid 17% lower despite good numbers. Interarch, again, an earnings reaction over here, stock down by 13%. And you've got cuts coming through in many of the other sugar names like Dwarikesh, Andhra, Uttam Sugar, some of the smaller ones, and Sterlite Tech, after the record rally, is seeing some profit booking today. But while all eyes globally are on Trump and Xi Jinping, there's a BRICS summit which gets underway in New Delhi today. Foreign ministers are expected to discuss issues pertaining to tensions in West Asia and the global energy crisis. So External Affairs Minister Jaishankar will meet foreign ministers from Russia, Iran, South Africa and Brazil. Chinese foreign minister is going to skip the summit on account of President Trump's visit to his own country. We'll keep tracking this for you. For now, it's a break. On the other side, the management of Reddington will join in to talk about Q4 numbers. Stay tuned. Welcome back. Let's talk about Reddington. Stock is up 3.5%. Steady set of Q4 numbers. Revenue growth stands at 25%. Margins have been stable, slightly lower quarter on quarter and on a year-on-year basis. And at the bottom line, you can see a slide, but that's on account of an exceptional loss of 152 crore on account of an impairment in Turkey. V.S. Hariharan, Managing Director, Group CEO at Reddington Group, is now joining in. Thank you very much, Rima here. Now, you've mentioned that West Asia conflict had a temporary consequential effect on operations in the month of March. Can you quantify the revenue and EBITDA impact on account of this?
Thank you for having here, Rima. I just want to correct some facts before I talk about the Middle East crisis. So the impairment that you talked about was an exceptional item, just as much as we had an exceptional item last year on divestment of Paynet. So year on year, actually, both on revenues and profits for the quarter, we have had a very good growth, 25% on revenue and 16% on profit. This is despite the crisis, the West Asia crisis, and that has affected largely UAE, to some extent Saudi Arabia. And for the month of March, we saw a degrowth of about 25% versus our budget plans. So we fell short by about 25%. That had an impact. And we expect once the crisis is over, that to recover fairly fast.
Okay. And March, I presume, is 1/3 of the overall quarter, or is it on account of year end? There is a spike. I mean, how significant is that 25% budget shortfall? Could you put it in revenues and margins, EBITDA?
In a typical quarter in Middle East, we would do about in a typical month, we would do about 400 million. So if you quantify, let's say 25% of 400 million is about 100 million shortfall, and an equivalent gross margin shortfall of about 4.5% to 5%. The good news there was we got a little bit more mix towards Software Solutions Group, which is at a higher margin. So that helped. But the hardware part of the business was what was stressed because of supply chain disruptions, not being able to bring in the product, not being able to ship out product, etc. We had to resort to more air shipments versus sea. The Straits of Hormuz was closed, but I think we did well. All in all, our warehouse operations, our local teams all jumped into action. We also had some data center attacks where we had to migrate and transition some of our customers from one data center in the Middle East to other geographies. But I think once this recovers, we do see a spring back potentially fast enough.
Yeah. So a $125 million impact is what we've seen in Q4. I suspect that has continued even in April and the 1st of May, that kind of a run rate, lower?
This quarter, we do expect to see a 25% on that part of the business. But if you put it in perspective, Reddington is very diversified, many geographies, many business units. India has grown the last quarter 50%. And even the some of the Middle East countries like GCCL, we call them, GCC countries and Levant, has also grown very well. The last quarter, despite the crisis, we grew at 51%. That includes countries like Qatar, Kuwait, etc. So it kind of compensates for some of the shortfall there.
Of course, it's just that the investor attention, everyone's attention is squarely on Middle East, which is why the persistence to ask about the impact on the company's financial. Even on cost side, there has been an increase, a spike in costs. You outlined that you had to do some air shipments, for instance. So do you think it's difficult for the company's EBITDA margins to get back to 2% plus? In Q4, as per our calculation, you were at 1.8%.
That's not really correct. It is more closer to 2%. I'm not sure what basis are you using for the calculation. It's closer to 2%. But we believe, see, the UAE part of the business is about 15% of the business, and you're talking about a 25% impact there. That's not necessarily impacting the whole thing. And we did have increase in costs. It's true. It's on account of war-related insurance, war-related premiums on freight costs, etc. And that was like a 0.2% impact on costs. And some of these will get passed on to partners and customers. The real impact is the revenue that drives some of the lowering of gross margins, and that's the direct impact. We did have one-offs as well on some AR provisions we took in Saudi for the quarter, but we expect to recover from those. These are provisions one takes because your collections are a little bit slower than planned.
Okay. So you said 25% top line growth for FY26. What is your own estimate based on the visibility right now of EBITDA margins in FY27 versus FY26?
See, outside of one-off data center deals and the big deals we do, our plan is to be around 2.2 to 2.3% EBITDA. So that's what we always strive to do. So our goal is to be somewhere between the 2 to 2.2 range for sure in FY27 is our goal and plan. And that's how we are working towards it in terms of...
And if you take into account the data center side of it, what would EBITDA look like?
We don't know yet. It depends on how much we want to appropriate deals on data centers. So we talked about just a little while back that we've done about 1,500 crores worth of deals in the last year. And clearly, the growth in the data center in India is going from 1.5 gigawatts to 7.5. So there's a lot of deals available from neo cloud operators. But we look at each deal closely, more from a return on capital employed perspective. The gross margins are definitely on these deals much lower than the typical gross margins. So I couldn't really say. It depends on the quantum of the deals we want to take on, and we are beginning to now clearly call out how much the volume of the data center deals, so that we know that the core part of the business outside of data center continues to be in that 2 to 2.2% EBIT, while the other deals will be taken on as incremental profit.
Okay. And data center, is it the 1,000 to 1,500 crore of data center? Was it the order wins, or is it the revenue that accrued in Q4?
It's the revenue that accrued in the year. Yeah. For the quarter.
How much lower are the margins? You said gross margins on data center is lower.
Yeah, it's very difficult to say. It's quite, it depends on deal by deal. So we cannot quantify a specific number, but it can be less than half of the normal gross margins.
Just coming back to the Turkey business, and we've been looking at Redington for the last couple of quarters, and the Turkey business has gone through its own challenges. I mean, the country has depreciation, inflation. I remember a couple of quarters back, there was a provision that you had to take for some of your customers. There is now that, the brand, on the brand side as well, you've had to write down some of the value of that. Do you think in hindsight, the Turkey business was a bad bet for you?
See, this was taken nearly 20 years back, and clearly we've had ups and downs. But looking at the last 2 years, we've had many challenges. The interest rates have gone up from 10+% to 50+%. Now it's come down, but it's still between 40 and 45. The inflation rates used to be like 65. It's come down to 40. It is definitely a challenging environment, but one would not have seen that challenges will get compounded so much. But we've had our good times as well. We did divest a nice, interesting business that we built on PayNet, and that got divested last year in Q4, if you remember that. So that was a good bet. Overall, we have now got a business which is half the size of the business that we had, very focused on US dollar, no lira business because the borrowing rates are high in the lira business. And we believe that we will do a good job of sustaining this. And you can see Turkey now beginning to jump onto the cloud bandwagon as well. So there are two parts of the Turkey business, one focused on software and cloud and one focused on hardware. And we do see some good uptick and growth on the software side. And we are just hoping and praying that we'll continue to navigate the tough environment and this business will come of shape to contribute as well.
Thank you, Mr. Hariharan, for joining in. Always a pleasure chatting with you.
Thanks, Rima.
Thank you. Well, the Nifty's now climbed above the 23,500 mark, led by strength in pharma, metals, couple of the PSUs. The Nifty CPSE index is also up nearly 1%, but on the flip side, IT is struggling. The Nifty IT index has moved to the day's low with a fall of 2%. That brings us to a close on this edition of Bazaar. Thank you very much for watching from the entire team.